Benjamin Franklin once said, an investment in knowledge pays the best interest. And that's what we're here for today and tomorrow, to share knowledge, insights, future prospects, and to give answers to the most valuable question, what's the future of financial services? My name is Felix Uhlig, I'm your host, and I'm really thrilled for the upcoming talks, discussions, keynotes with over 40 panelists and keynote speakers from all around the world, covering the most important fintech focus areas like corporate banking, wealth and asset management, customer experience, diversity, sustainability, and more. It's now short after 4 p.m. here in Frankfurt, Germany, and I'd also like to welcome everybody at their screens watching us right now. Maybe it's at home, maybe you're in the office, maybe you're in your kitchen, in your living room, or maybe even in a taxi on your way back home from work. Welcome to Fintech Europe Expo 2021.
Data,
artificial intelligence,
APIs,
and automation,
IoT,
behavioral finance,
and real estate,
cloud native,
secure, private.
Now, before we start, I would actually like to make sure you're all there, you're all awake, you're all excited for day one of Fintech Europe Expo 2021. And what I want you to do right now is put your hands in front of your screen, above your keyboard, and just type in a little hi from wherever you are, or even a smile or waving emoji. Let us know you're there. We'll see the messages here. Perfect. Oh, ciao Milano. Great to have you. London. Amazing. This looks really... Stuttgart, hi. Ah, perfect. Pretty amazing already. Great to have you all here. And make sure you also participate in the online conversation using our very special Twitter hashtag we've created for today and tomorrow, PNP Fintech. Hashtag PNP Fintech if you post something on Twitter. And if you want to participate in the conversation, also use the Facebook chat when you're watching us on Facebook, and use YouTube chat. I think the YouTube chat window is here on the right-hand side, so we see your messages and your comments. It's now time for me to introduce our very first guest of today. It's my great pleasure to have him here today. Please welcome the director of Fintech Europe Plug and Play, Fernando Zornig. Hey, Fernando.
Hi, Felix.
It's weird because usually we have we're actually standing on a big stage. We have audience, but we've seen the chat messages. We actually have people watching us right now.
Yes, it's a pleasure to have them there watching us through their own homes or wherever they are.
Yeah, I'm actually pretty excited where they are right now, if they're in the office or, you can type that in as well. Fernando, let's talk about Plug and Play, about Fintech Europe Expo. How did this all start?
Yeah, Plug and Play has an extensive history. I would not go into much details right now, but the fintech practice started back in 2015, and since then we grew the business model to what we have today. We're always evolving, we're always growing, and we're always looking to bring in new players into the ecosystem. So today, it's a day of celebration, bringing knowledge to everyone else, sharing that knowledge to the audience, as well as celebrating the accomplishments of our great startups that we've been working with in the past year.
Sounds great. So later on, we'll have Bernd Leukert with us. He's Chief of Data Technology and Innovation at Deutsche Bank. Tell me, how important are executive buy-in innovation initiatives like this?
Executive buy-in is one of the most important things for when it comes to innovation. It's essential. You need to have that buy-in from any kind of C-levels, the CEO, CTO, CDO. It always helps push the initiatives forward, and also for them to reach some results, right? Of course, it's a matter of a cultural mindset, so it's also portraying that cultural mindset back to the overall organization. And that's why it's really important to have their buy-in.
So in the next 2 days, we have 9 focus areas. give me like an insight. What's your like most important focus area you're actually looking forward to seeing in the upcoming day?
Yeah, I mean, for me, I'm a little bit biased. I like all of them. I think all of them are equally important for the financial services industry. I'm really looking forward to the wealth and asset management, as I've already worked in the space before coming to Plug and Play and working on technology. So that's one of my dear and special area.
Well, Fernando, thank you very much for your time. I'm really looking forward to an exciting expo, and we'll seeing you soon as well, right?
Thank you very much. Looking forward to it.
All right, Fernando Zornig, ladies and gentlemen. Now let's discover more about Plug and Play's FinTech program.
Welcome to Fintech Expo.
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 Plug and Play Fintech is an open innovation platform that connects leading corporations in the financial industry and innovative fintech startups.
Our platform is based out of Frankfurt, Germany, and has grown its partner base to 12 financial institutions since its inception in May 2018.
Together with Deutsche Bank, BNP Paribas,
Netz, UniCredit, Nexi, Abanca, Arealbank,
DZ Bank, Elo, Ubibanca,
Alpha Bank and Raiffeisen Bank International.
The program seeks to support innovation in the world of financial service.
After screening applications from all over the world and intensive weeks of reviewing pre-selected startups with our partners,
the final group of companies are accepted into the program.
The aim is to facilitate pilots, POCs, and business development opportunities for the participating startups and financial institutions.
So we wish you a lot of fun and
welcome to Fintech Expo.
Join us now for the welcome speech of the Mayor of Frankfurt, Uwe Becker. Hey, Mr. Becker, great to have you here.
thank you.
We have to actually bridge the audience and the applause that's missing here right now. I hope that is fine for you. Great to have you here. It's an honor to have you here. How has 2021 started off for you? How are things in Town Hall?
Things are dynamic and challenging as always, but the easy job is for everyone. So we're managing the city and we're good on the start of 2021, besides all things that we have to face with Corona. So.
Absolutely. So dynamic start, and I'm sure you have some dynamic welcoming words for our audience. The virtual stage is yours.
Thank you. Yeah, ladies and gentlemen, I'm very honored and pleased to be able to welcome you officially in the name of the city of Frankfurt, in the name of the city government, the magistrate, as well as in the name of our municipal assembly, and a warm welcome to this very special FinTech Expo 2021. When we look on the challenges that we have to face, and I mean the challenges besides what we're now dealing with Corona and getting through this period into a new form of normality, what we had before and what we will have in the future is Frankfurt being the #1 spot in Europe for the development of new technological answers to the questions on how markets will be in the future, how the fintech situation will be. Together with the state, the city of Frankfurt has developed a master plan in supporting and enhancing what startup companies can do and will do in our city, what new rising stars will be able to deliver, and what will be the outcome. And if you look on the city of Frankfurt and if you compare it to other situations, you very well see that the #1 spot for the future of economy on the continent in Europe is Frankfurt. Of course, as the economical center, as the financial place in Europe. And that's where the market is, especially, of course, the market for fintech companies. If you want to go fishing, you don't go to the desert. If you want to go climbing and hiking, you don't go to the beach. And so if you, in the past, did not look onto Frankfurt, now here is the place where the market is, where the big fishes are, and where you're able to hike, when you go to new challenges, and where you're going to be confronted with the market is asking you for. The financial center of Frankfurt, with the seat of the European Central Bank, with many companies around the banking market, with fintech, of course, with prop tech, with legal tech, with all the industries that are here at this place, which is, to my mind at least, the most natural place for young and dynamic companies. You can be part of this, and of course, within the next hours, You will discuss a lot of these issues. What is the part? What are the challenges? What will Corona bring as new challenges for our new normality, in which we probably live different than in the years before, where we took a lot of things pretty much for granted? That you are not taking things for granted is proven by your personal history, your story of your company, the story of your startup. So again, a very warm welcome. I would have loved to welcome you live and in person, but I think this is also, when we speak about technology, a way where you're now able to work, able to discuss, and to deliver the results. So again, thank you very much. I wish you success for this year, 2021, and for all of us, stay healthy and everything. Bye-bye.
All right, thank you very much, Mr. Becker, for these warm, welcoming words. And we'll be back shortly in just a few seconds, and we'll welcome the founder and CEO of Plug and Play Tech Center.
Hello, my name is Kate. I work in EXPO Bank as the Innovation Manager.
Hi, my name is Alma Šarić. I'm a Strategic Partnerships and Ecosystem Manager here at the Raiffeisen Bank International.
My name is Istvan Kovac, and I'm a Senior Strategic Partnerships and Ecosystem Manager at Raiffeisen Bank International.
Hi, my name is Kristina Kulichkova, and I'm the Professional Strategic Partnerships and Ecosystem Manager at the Raiffeisen Bank International.
Coordinator at Banca Innova.
My name is Alex Bernardo, and I work as an Innovation Manager in Abanca.
Jörg from DZ Bank. I'm Senior Manager Innovation and Digitization in the Strategy Department for the DZ Bank Group.
My name is William Powell. I'm working for the Deutsche Bank API program. I'm responsible for community management and for events.
I'm responsible for the startup activities at Ariel Bank Group.
My name is Daniele, and I work at Nexi as Head of Strategic Partnerships.
Welcome to Fintech Expo.
Welcome to EXPO Day.
Welcome to Fintech Expo.
Welcome to EXPO Fintech.
Welcome to EXPO Day.
It's now my honor and great pleasure to introduce to you the CEO and founder of Plug and Play Tech Center, Saeed Amidi. Saeed, welcome.
It's a pleasure being with you from Silicon Valley to celebrate our expo in Frankfurt.
Well, Saeed, this is probably like the biggest gap we're actually bridging in this conference to Silicon Valley. How are you? How are things in Silicon Valley right now?
You know, like everywhere else in the world, we are hoping that very soon we will go back to the normal life. But it has been a very positive and incredible year for Plug and Play here in California and all around the world.
That sounds great. So I know it's a little bit like looking into the crystal ball, but time has flown by like never before. It's now 2021. But can you tell us, can you look into the crystal ball and tell us what's emerging, like what's going to be new? What innovations are we expecting from Silicon Valley soon?
Wonderful. Let me, sometimes when you like to look into the future, it's important to look in the past. In 2020, we had an extraordinary year with 5 new unicorns. One of them was in InsurTech business, Hippo. One of them was in compliance business and analytic business, Big ID. Other ones was like a special messenger business called Customer that Facebook purchased for over $1 billion. So if I wanted to use that as an example, I feel if you have the right technology and you're solving a real problem, 2021 will be a great year. This challenge that the world has gone through shows us that more than ever before, technology and innovation is needed in our daily lives. and connection between people and connectivity is going to be the future of everything: e-commerce, last mile delivery, AI, etc.
So Plug and Play Tech Center has a big experience in working with large corporates, right? What advice would you actually give C-levels and or high executives that are looking into innovation strategies right now?
You know, we work with more than 100 large financial organizations like Deutsche Bank, Allianz, Munich Re. And if you, for example, see the Allianz investment in N24, it's the evidence that the big organization, big corporations need to collaborate with startups during this digital transformation. Of course, you know, there is great engineers, great people in this large organization, but the whole industry is moving so fast that with internal R&D and internal development, you cannot keep up with the present world. So my recommendation to the C-level executives in Germany and around the world is you have to have an open mind, open culture, and work with what I call open innovation, collaborating with startups, and sometimes even with your competitors.
Even with the competitors, like having an open mind. I actually like the picture of having an open mind very much. So thank you very much, Saeed, for these short, insights into your future prospects. We'll hear you later on with Bernd Leukert from Deutsche Bank at the Fireside chat. Thank you for now and see you later.
Wonderful. It's great being with you, and I wish you a great show and a great expo.
Thank you, Saeed. See you later.
Thank you. Thank you.
Our next guest has an incredible CV with a lot of prestigious stations in the financial world. He has worked for Goldman Sachs for 18 years and he's left his position as co-chief executive officer of Goldman Sachs AG and managing director of the Frankfurt branch of Goldman Sachs International in 2018. Since then, he's been state secretary for financial market policy and European policy at the Federal Ministry of Finance in Germany. Please welcome Dr. Jörg Kukkies. Hello, Mr. Kukkies.
Hi.
Great to have you here. Mr. Kukkies, tell me, after probably a really, really intense 2020, how has 2021 started off for you?
Well, given that we are obviously dealing with a very difficult situation in the corona field, both from a health policy, but for us in the finance ministry, of course, also from a finance policy perspective, it hasn't really calmed down yet.
So you must be one of the most important, actually, and one of the busiest persons in Berlin right now. Is that right?
Certainly it hasn't calmed down. I mean, with the EU presidency, of course, and all of the issues that we had towards the holidays, including the very last minute Brexit resolution, I don't think it gets more hectic than finalizing a Brexit deal on Christmas Eve. But yeah, it certainly hasn't calmed down since then.
All right, Jörg. Feel free to take it away from there. I'm pretty excited on what you have for us.
Yes, thank you. So obviously I'll focus less on the topics like Brexit or in response to the Corona crisis and more on the digital issues and all of the technology issues that we're facing here and we're trying to do to make the German financial markets more digital and more innovative. So in that sense, I said that I'd talk a little bit about our legislative proposals. What we're very excited about that is now at the going to Parliament is our e-securities legislation, where we will give all issuers and market participants and service providers the opportunity to completely change the way fixed income securities are issued, traded, custodied, settled, with the possibility to remove completely the analog world of paper settlements and go completely into the digital tokenized world. And that will be implemented for any kind of fixed income security, both in the possibility to issue the securities in a purely electronic format, but also to use blockchain technology to issue and settle all of the transactions that are foreseen. So in that sense, that'll be a real innovation. And we're also going down the electronic route for mutual fund shares. We're not yet at the stage of using blockchain for that. There are some legal issues we still have to overcome for that. And of course, that is the opening door once we have our securities law modernized in such a way that it is blockchain compatible. Of course, the next step would be to think about issuing equities on the blockchain. We're not there yet, and that's not part of our current legislation, but certainly could be foreseen for the future. And then, of course, we're getting very positive feedback on our crypto custody legislation that we passed, and that is really promising. We've had over 50 inquiries from blockchain companies that want to use that legislation to register in Germany. So in that sense, we're seeing a really strong inflow of companies interested in building up and expanding our ecosystem here. And of course, to accommodate that, one of the big deficiencies that we've always had in Germany is the very difficult tax treatment of employee shares that startups and fintech companies offer to their employees. And we are just in the process of passing legislation also to eliminate the so-called dry income problem that we've always had in our tax system, where if you receive a share of your company, you immediately become taxable with the full amount of that. And that will be addressed and fixed through a system where you can actually defer the tax event for several years, ideally until you can sell your shares. So in that sense, that's something where we are very optimistic that for the startup scene, one of the big issues that's always been addressed with settling in Germany and building a business here will be addressed. We're also doing a lot to attract financiers of startup companies to Germany. On the one side, we are launching a 10 billion future fund, Zukunftsfonds, that will be available to finance innovative business models through quite a lot of the instruments that we had established during the crisis with our 2 billion Corona matching facility. We will significantly expand that and provide supplemental financing to private sector financiers of startup companies that will simply increase the volumes of financing rounds, will introduce new and innovative financing techniques that will allow us also to provide much more capital to the startup scene in Germany. And we're working together with KfW, with EIF, with the high-tech Gründerfonds, which some of you may know, with Coparion. So we're basically significantly levering up all of the instruments that we have to provide co-financing by our public sector instruments, of course, always in concert and together with private sector investors that we will match and increase the volumes of their investments. So I think that's going to be another boost to the size of our ecosystem in Germany, and we're very keen to get that going. Additionally, we're in the process of tearing down another hurdle for the very important venture capital industry. So far in Germany, as one of the very few states in Europe, venture capital companies that settled in Germany had to pay VAT on their management fees, which is an 18%, 19% competitiveness disadvantage for Germany relative to a lot of the other EU member states that we're competing with for talent. That will be abolished. We're in the middle of legislating that. So in that sense, it'll be another boost to to attracting startup finance to Germany through the institutional VC funds. And of course, we're hoping that that'll become a much bigger part of our ecosystem, that we have more VC funds settling in Germany, and that is intentional, that we're trying to lure those investors into our country, because of course we know that venture capital is absolutely essential for the growth of startup ecosystems. Of course, we're moving in a very European context. During our EU presidency, we were able to start the discussion around the MiCA and DORA legislation at the European level, i.e. On the one side, crypto resilience in DORA, and on the other side, markets in crypto assets, where the European Union will be the first major economic powerhouse and region to develop a consistent and coherent supervisory and regulatory framework for anything that is related to the stablecoin idea. So in that sense, I think the European Union will really be thought leader globally on this topic. As I said, we advanced already pretty far in the time period in September, October, November, December, where we were able to start the discussion on this topic. And we just today had a intensive and long discussion with our Portuguese colleagues who took over from us as the EU presidency to continue that work. So in that sense, we're very happy that Europe will also be part of this big innovative push into tokenizing and digitizing our financial sector, and we're very happy that during our presidency we were able to advance that. And with that, many thanks, and over to you back in the studio. Thank you.
Our next guest is a client partner at Facebook Germany with more than 10 years of experience in the financial services and technology industry. In his current role, he advises organizations on their online strategies across Facebook, Instagram, and WhatsApp. Prior to joining Facebook, he worked at Deutsche Bank and Google. Please welcome David Dommel. Hi, David.
Hello, Felix. Nice to be here.
Great to see you, David. How are things at Facebook, and how did 2021 start off for you?
Well, thanks a lot for asking, Felix. 2021 started pretty much like 2020 ended. As you can see, I'm still only able to join in a virtual fashion. And this is because we've basically moved to a completely remote workforce as of March last year, and are still in that mode on a global level pretty much. So again, we all hope to venture into a bit more of a normal situation pretty soon, as I assume you're also hoping.
So actually joining a digital conference online is nothing new for you today?
It isn't, no, it isn't, unfortunately. But again, my hopes for 2021 are that very soon we'll be able to see each other physically again. And yeah, I'm looking forward to hopefully attend future sessions very, very soon in person again.
All right, and we're really excited to see your keynote. Whenever you're ready, take it away.
Fantastic. Thanks so much. So again, hello everyone. As Felix said, I'm David. I'm part of Facebook's financial services team. And in my role, I've had the privilege of working closely with many successful banks, but also fintechs. And I've seen firsthand the incredible business value that is unlocked when using reliable and accurate data to drive one's marketing. So your data really matters as a company. And this is what my talk today is going to be about. So it's whether you're trying to preserve your marketing effectiveness, let's say as a bank or insurance provider, or whether you want to scale up your business as a fintech. It's leveraging information about customers that is always mission critical. So in this talk, I will try to show you what is currently changing in the advertising ecosystem and how Facebook can help your company prepare for these changes. So if we look back at when e-commerce first emerged, it was considered highly experimental. So marketers and people alike were really slow to adopt this new channel at the time. But since then, there has been a slow and steady climb towards direct sales online across industries. And that's also true in the financial services industry, of course. So for people, it's utilitarian, it's price driven, and the convenience of it has driven more and more people to transact online. However, interestingly enough, the playbook for marketers has pretty much remained unchanged for almost 20 years. Now, this connected world that we live in now has given people infinite choice and total control over what they want to watch, what they want to read, what they want to buy. And as a consequence, today, people expect that experiences are more and more tailored towards their personal taste, towards what they, towards the formats that they prefer. And as we've mentioned already, right now, we're living through a pandemic of a global scale. And this has resulted in significant behavior shifts. Now, what has changed is that online transactions are no longer a convenience as they have been in the past 20 years, but they are a lifeline for people today. And as this global crisis is keeping us home, 10 years of digital transformation happened last year within 2 months. Now, this shift is dramatic, but it's not really unexpected. It's just coming in earlier. So if I take a step back and look at our perspective from a Facebook point of view, the businesses that we see winning in today's market have recognized that the consumer journey starts well before the intent to buy a product or service. These businesses, they really obsess over the customer journey and the many paths to a purchase. They understand why meeting demand might still be critical. It is really vital today, more than ever in this pandemic that we're living through, to create demand. And they do that through discovery. I have a few examples here on the slide. I hope you can all see that. So these types of businesses have been investing more than ever in the last couple of months into a more modern kind of marketing. And it is something that we at Facebook like to call discovery commerce. Now, discovery commerce enables businesses to go one step further than they can with any other marketing. Again, it's not just meeting customers' needs, but really anticipating them. While e-commerce is about search and then purchasing through a website, that means people are limited to finding the products they already know they want. Customer experiences that are enabled by discovery commerce have a different view. So there it's about products and services finding the right people so that these people can discover the things that they most likely care about. This is also true for financial products. So discovery-focused businesses share 3 common practices. 1, they root their marketing efforts in a data-driven understanding of how people are interacting with their business. 2, they create customer-centric experiences that meet customers where they are. 3, they organize their teams for agility, which includes structuring teams to communicate efficiently and empowering those teams to use data to make decisions that best serve customers. Now, if we look at Facebook, Facebook is an enterprise solution really for demand generation. That's really what it is, bringing together all the tools that a financial services company needs to grow. So the first layer really is rich data. It's understanding what's important to people and how they interact with your business. The second layer is sophisticated advertising tools. So that means putting that very data to work, helping your product find the right people. And then the next layer on top is engaging services. So that is making it faster and easier for people to buy or sign up for your service. And powered by the very most important layer, the fourth layer that really underlines everything, that is the secure data handling, that is protecting people's privacy and respectfully using data to drive personalized marketing. So our system makes it possible to deliver personalized experience across each of our apps, whether that is Instagram, Facebook, Messenger, or even WhatsApp. So it is in a community of more than 3 billion people that use our apps, but no two people using our apps experience the same visual impressions when they use our apps. It's no two people's experiences that are alike, really. People, of course, are complex and surprising, right? Each person has a different set of interests, different experiences, needs, different wants. And we're able to align with those very unique facets because of our understanding of people. However, nobody knows your customers better, of course, than you do. So it is when you share what you know about your customers that you help our systems find the people most valuable to your business. Through machine learning, then Facebook can choose which of your creative assets are most relevant to each person using the service. And then when people connect with those messages, they can move from the discovery phase, where they might see your insurance product, your banking product for the first time. They might then move to purchase, or to a stage where they are considering which solution really to opt for. They might sign up for a current account, a trading account, for example. So this is really the engine that powers our online marketing today. Now, what we see on this picture here is, this is the largest diesel engine in the world, actually. It can generate up to 100,000 horsepower, which is, to put it into perspective, which is enough to power an entire small town. And these engines, they are really designed to power ultra-large cargo ships. You can hopefully see this, this one example here on the slide. Now, what I would like you to do is imagine you're trying to keep your ship afloat, but you're facing a challenge with the engine powering that very ship. And this is what's happening in marketing today. Similar to the captain who cares deeply about the fuel feeding his engine, marketing teams care deeply about the data feeding their advertising engine. And right now, as of today, most companies on Facebook use the Facebook pixel pipeline to fuel their advertising. A pixel is a piece of code that lives on your website. And it captures the information you choose to share about actions visitors take, such as if they opened a bank account, or they signed up for a newsletter, or they bought an insurance policy, for example. Now we can use that information to match your customers back to a Facebook profile to help you with targeting the right people, optimizing your advertising campaigns, and of course measuring their effectiveness. But in today's world, there is a growing problem with Pixel. It relies on web browsers to collect that customer information. And that matters for two reasons, really. First, browsers are not always the most reliable way to capture data. This is an issue every financial services company already faces today when advertising online. So more and more of your customers are probably using ad blockers, but also loading errors and connectivity issues could prevent you from capturing valuable events. Second, recent and impeding browser changes, including limitations to the efficiency of cookies, they will make it way more difficult for websites to share information about site visitors' activities with their advertising and analytics service providers. This is really an example of a massive industry change that will impact your ability to share data through Pixel. Now, I understand that implementing data pipes and capturing customer events might not be everyone's favorite topic for a conference. However, it is critical to recognize that it is your ROI that is at stake here. The better data our machine learning algorithms have, the better decisions our systems make, and the more likely people are to engage with your ads and take a desired action. So today, what I will do is I will try to uncover how Facebook's Conversions API can help you overcome this challenge and help you gain control of your data in a way that preserves both the effectiveness of your advertising while respecting your customers' privacy choices. First, let's talk about why the industry is moving away from the primary technology it relied upon to deliver relevant and personal ad experiences in the first place. The short answer here is that people are hungry for greater data privacy. So it is important, especially for you as financial services companies, to strive, again, for both, for data privacy and personalization, so that people are getting the benefit of targeted advertising that I personally deeply believe in, to find relevant offerings, relevant services to them, while they have more confidence that their data and privacy choices are protected. It's really not a dichotomy, it's an and rather than an either or. And browsers are beginning to implement changes today that will hamper websites' ability to share data with their digital analytics and advertising service providers, as I've said before. So to give you an example, at Facebook, we expect the world's most popular browser to either materially or completely limit the efficiency of third-party cookies by 2022. However, that timeline is just an estimate. This could happen at any time, so it is important to start planning for these changes already today. Now, what's our proposed solution for that? It is what I referred to earlier as the Conversions API. Now, the Conversions API helps you get ahead of these changes by allowing you to share data from consumers for whom you've, of course, received consent and explicit permissions directly from your server rather than through the browser. You can hopefully recognize it in my slide here. The API is also designed to honor Facebook's user privacy controls. To give you an example, if your customers use our off-Facebook activity privacy tool to limit whether their off-Facebook activity data is associated with their Facebook accounts, those user choices will extend to data sent via the Conversions API, of course. In this way, we allow you to keep providing customers with relevant experiences while supporting your efforts to provide users with appropriate data transparency and control. Now you may wonder what happens if you don't become more browser independent as a company. I want you to imagine the following. Imagine going into your next leadership meeting and reporting that your company's cost per action has increased by over 150%. That's the equivalent of losing over 60% of your marketing budget. Imagine the impact that could have on your business. But actually, believe it or not, this was the exact outcome of our test that we recently ran, comparing the acquisition costs between an advertising campaign optimizing towards conversions and another campaign optimizing towards clicks. Because today a web pixel allows you to capture a conversion event. However, if you don't really have the capability in the future, you may only be able to optimize your campaigns for clicks, which only considers if people clicked on an ad, not if they ultimately bought your product or signed up for your service, let's say. So how can Conversions API help keep your advertising effective and affordable in a world that doesn't rely on data sent through browsers? What Conversions API helps you do is measure and optimize your ad campaigns for the outcomes you want, using the data you control rather than data from a browser. There are advantages to adopting Conversions API today, whether you keep Pixel or choose a standalone implementation. For most advertisers, Conversions API can help make their data sharing more reliable while opening up the capability to share events that are closer to their true business outcomes. First, control the data you share and when you share it. Advertisers can choose to append insights like product margins, for example, in discrete fashion. Second, strengthen how you share data with Facebook. Data sharing through Conversions API may be more reliable than browser-based methods, as the Conversion API is designed to be less susceptible to issues like a browser crash or connectivity issues, as I said earlier. And thirdly, more insights into the people who matter to your business. Advertisers can use a wider array of data to inform their advertising than is currently captured by Pixel on their website. Think of CRM data or lower funnel events that can't be captured on websites, such as leads that have been qualified over the phone or multi-site conversion paths. Today, Pixel sends data automatically when an event occurs. A standalone Conversions API, however, will allow you to decide the following: what to share. For example, if you want to send sensitive product margin information, you can use a secure API rather than the browser. Secondly, when to share. Pixel shares information immediately, but if you wanted to only send events to Facebook that were qualified through an application process, you could delay sharing until that very process was completed. However, we do recommend that sharing is as close to real time as possible, ideally within a few hours. And thirdly, whether to modify or add to the data that you share. For example, you might want to include customer value scores, or whether a customer has opted into a mailing list. Conversions API also helps to ensure more reliable data sharing, and it doesn't rely on browsers for information. If you're passing the same events through Conversions API and Pixel simultaneously, this data sharing can safeguard against data loss in the case the data is dropped by the browser. It will then still be transferred, but through the API, making everything safer. Now, pairing Pixel and Conversions API also helps to enable full funnel visibility. What does that mean? When we talk about full funnel visibility, we're really talking about your ability to paint a more complete picture of your customer journey. Conversions API allows you to share more data sources with Facebook, and the more places you can see customer interactions occur, the better you are able to measure how your campaigns on Facebook performed, the better you're able to target different types of audiences with messaging that is specific to them, and optimize towards events that matter the most to your desired business outcomes. To make it a bit more precise, Conversions API allows you to pass along web and offline events like data from your CRM, qualified lead information you gather over the phone, for example, or even significant customer interactions that may happen in a bank branch. Many of these events aren't captured by a pixel as they do not occur on your website. So this could give you a leg up in reaching the right customers with the right information. We expect contact information to be essential in connecting customers' action back to user identities in the future. When Pixel can no longer automatically pass along customer information, you will have to explicitly choose what information to send and actively send it along with your events to maintain the effectiveness of your ads. So adopting Conversions API today is really a proactive step that can help you safeguard your advertising from the performance degradations really that we expect to happen in the next year or even before. We want to help you lean into data practices that allow you to better respect consumer privacy and treat data as a valuable asset. Investing time and technical resources now will help you avoid a last-minute scramble to change how your system works in the future. It will also immediately give you more control over your data and also open up new avenues for success, as I've hopefully been able to show you. All right, so we talked about some of the changes in our industry. We talked about how the Conversions API can help you navigate them and why it is important to integrate it as soon as possible. I hope with this, you will feel equipped to face the opportunity of implementing personalized advertising in a privacy-first world and really maintaining that balance as it is essential to your business success. Thank you very much.
Financial institutions are looking for innovative ways to engage with their customers. To address customers' high expectations, corporate startup partnerships have become increasingly important, and the COVID-19 crisis has especially shown the need for collaborations. Here's our customer experience report.
Financial institutions are looking for innovative ways to engage with their customers and offer new services to differentiate themselves from their competitors. The industry landscape has changed at an astonishing speed in recent years, and fintechs are obtaining banking licenses, extending the current products in the market, and attacking some of the most profitable elements of the financial services value chain. Financial institutions have to overcome other challenges, as new regulations, the exponential growth of data, and the limitations of legacy systems, which have a crucial, direct impact on the end user's customer experience.
I think every single consumer can attest to the fact that a good customer journey is a customer journey where you don't at any point in that customer journey has a step that feels inconvenient. You get the right guidance at the right time where you're in doubt about what you have to do. Consumers today are looking for convenience above everything else. So if you have to choose between paying two different ways and one feels inconvenient, you will always go with the other way.
We believe that collaboration between financial institutions and third-party technologies is the key catalyst to provide a digital-first, customer-centric experience.
Yeah, so the banking industry has a big challenge in the sense that the entire banking value chain has been unbundled. And that means there's a lot of services, whether that's in lending, whether it's in cards or accounts, all over the place, where there's a lot of specialized companies, but they are unbundled, so there's a lot of different apps. And now there's a rebundling of that that's happening currently in banking. What Azure is doing to address these challenges or to improve these services is to connect banks to a platform to which other fintech services are connected. And then we look at the bank transaction data, your data, to see what your problem is today. Are you getting married? Are you buying a car, a house? Are you going on holiday? And based on that data, we can then make information or products available to the end customer through our platform. So at a minimal, we can create some triggers based on data, and at a maximal, we can build an entire new banking service on top of our platform.
In 2018, we started with the first fully automatic identity verification. We call it RoboIdent. And during the last months in the Corona situation, we helped like the German government and countless other companies to go live, to go remote within days instead of years or months at least. As by the end of 2020, we will come up with more trust services around our RoboIdent technology, for example, the e-signatures. So we are all about providing trust in a remote situation.
We have created a location-based matchmaking platform that connects those who want to withdraw cash in real time with those who want to deposit cash, which typically is a local shop owner like a bakery or a pizzeria or a bar or a restaurant owner. This way, the shop owner not only gets rid of cash, but also earns commission. It also attracts additional foot traffic to the store. You as a consumer can now withdraw cash at the click of a button wherever you are. And finally, banks can save up to 50% in running their ATM operations while generating additional revenue. We are operating the single largest ATM network in Switzerland. Starting from scratch to the largest network, it took us just 18 months, and we today operate more than 2,300 virtual ATMs across whole Switzerland here. And we are now emulating that model in other countries. We are going live in Italy, Germany, UK, Sweden, and even in Mexico. We are now expanding quickly because what we have seen is that once the network grows, it grows really exponentially. And then big financial institutions pay attention towards it. And that's what helps us become a true alternative to ATMs. We're about to announce a large deal with a very large global customer fairly soon, and I believe this is just the beginning.
So Bio gives bank customers control of their subscriptions, and we do that by giving them an overview of all the different recurring payments, canceling unwanted subscriptions, and notifying them about any changes to their subscriptions as well. From the bank's point of view, this gives the bank the benefits of lowering costs on customer support, driving up retention rates as well, and of course, generating revenue in our unique cross-selling model. Today at Sobio, we're working with 8 different banks, and some of those banks are ABN AMRO in the Netherlands, it's Nordea in the Nordics, it's Luna, the challenger bank. We're seeing that 60% of the end users are active within our feature within a year, so 60% active users. We have an accuracy rate in finding these recurring payments of 98.7%. We have over 22,500 different products that we have enriched, logos, names, with processes for doing the cancellation. So we really are a company that's focused heavily on the data and on the metrics.
Our market-leading technology helps enterprises across financial services and telecoms to streamline complex customer journeys into effortless experiences by replicating the qualities of a face-to-face interaction within remote channels. Our solutions offer frontline staff the digital tools to explain products, exchange documentation, and collect e-signatures remotely as if they were in person. This means that journeys that used to span multiple steps and channels can be simplified into a single interaction. This improves conversion rates, efficiencies, compliance, and of course leads to happier customers. And the beauty of it is that customers don't have to download software or apps.
It's mind-boggling the way we are evolving the customer experience, the customer journey. Every single interaction is under scrutiny of how can we be more efficient, how can we reduce cost, how can we scale it to a bigger level, and at the same time, how can we continue to make it so that the customer has as little inconvenience as possible. And I think that scrutiny is where we especially see that the fintech companies are coming in and saying, when we look at the value chain, we're looking end to end because that's how we service our customers. When you look at a fintech, their perspective is often that they take one step of that value chain and then they make it to their niche expertise. And that's why they often become, in a very fast way, much better at that than we do.
Now that we have a basic understanding of their solutions, we have asked our startups what it takes to create a good customer experience and how the financial industry differs from other industries.
A good customer journey always starts with the customer. So it starts with the problem and not with the solution. I see too many companies focusing on different technologies, like falling in love with IoT, falling in love with blockchain or other buzzwords. I think it's about starting with the problem and then working your way to the solution and then making that as intuitively as humanly possible.
I would define a good customer experience as one that meets the customer core needs while exceeding every service expectation at every touch point. On top of that, a good customer experience should be convenient for the customer, should feel effortless, and should be consistent across all channels.
I think peace of mind is the key driver for a good customer experience. Technology should do the work for you and not the other way around. Eliminating uncertainty and giving the assurance that the process works is key. I think trust is a key factor. If you are launching a service in the financial world, can I trust an app where I have to connect my bank account? Is it secure enough? And use that app to even withdraw my money. Gaining trust is key to any success in the financial industry, especially when you're trying to create a customer experience around cash withdrawal and ATM. Having trust embedded in the process is crucial to gain a kind of a distinctive advantage for having a cool customer experience there.
Well, I would say very simply, one aspect that we have in the banking industry that's very different than any other industry is that we have the trust of the customer, and we know exactly what's going on in that customer's life. Very few industries have such a holistic point of view of the customer. Enabling the options behind that is obviously what we're all about.
One special situation for the user experience in the financial industries is that you always have to stay compliant with everything you do. And being compliant and providing a high security is always a problem you need to solve and puts away your focus from the customer experience. So most financial companies put their focus on being compliant instead of having a very good user experience.
Next is taking care about the trends, both from the product side and what is happening on the market with our consumers, end users, cardholders, and our issuers. When it comes to the, for example, user experience, we are paying extra attention to look what will make their everyday job easier. So what do they need to complete what they do as much as quicker, as better they can.
You've probably heard about PSD2, the European regulation approved back in January 2018. This directive requires banks to provide access to consumer banking, transactions, and other financial data to third-party service providers. They do so through the use of APIs. The goal is to give consumers more choices by increasing competition between banks and fintech startups. For banks, open banking brings more competition, and it is becoming a major source of innovation that is poised to reshape the banking industry.
I think that some of the customers are currently not feeling very well prepared when it comes to sharing information between different banks, because I think that some of them believe that this is a security issue, that they can share their banking information outside the bank they are using, but in fact it's not.
Open banking allows the networking of accounts and data across institutions for use by consumers, financial institutions, and third-party service providers. Overall, open banking is transforming relationships between traditional financial institutions and their customers. It has shifted the narrative. Now, customers themselves have ownership of transactional data instead of their respective financial institutions. One key benefit for financial institutions of transitioning to an open API framework is that it will streamline internal efforts to launch digital products. That's because APIs decrease the costs and time to market for new products and services.
Yeah, so what we're building is far away from MasterCard and Visa. Because if we have to build our infrastructure on those existing payment rails, we will not be able to offer our product at a price point where we are currently operating. So for that reason, open banking is the kind of the most important ingredient in our business model. Because we connect with the banks using PSD2 and open APIs and initiate payment with our own e-money license and do a PISP transaction. And based on that, we are able to lower the transaction cost significantly and create value for all parties. So open banking is, one of the central element of our business. And we believe one of the challenges that we're trying to solve today is to have a unified customer experience in that open banking world. This still doesn't exist, in my opinion, because what we have seen is that most banks have done open banking just to stay compliant with the law and the regulation versus creating true value from a customer's point of view. But I think that transition is happening, and some of the progressive banks with whom we are working today are already exploring how to create a seamless customer experience and create value. Because if you look at the tech world where APIs are everywhere and we exchange data across multiple technology platforms, consumer adoption is nothing but a function of seamless customer experience. We need to bring that kind of customer experience into the financial world, and Sonect is well positioned to drive some of those key transitions.
I think that open banking will change the customer experience in the future in several ways. I think we've just seen the tip of the iceberg right now. So the infrastructure is in place in a lot of banks, in a lot of places in Europe. The use cases are still missing. So we're going to see a lot of use cases on top of this data. So I think the customer experience will be much more centered around what it is that the customer is experiencing, and the integrations and the ways of working with the banks is also going to change. So before it might only have been the IBMs, the Dells, the other ones, big companies that could work with the banks. But by having open banking, you're suddenly opening up for a lot of other third parties that have specialities within different verticals. So I think that will have a huge effect on the customer experience and the problems and pains we can solve for the end users.
And the core drivers of open banking from our point of view is, yes, data becomes more broadly available. That's very good. So behind that is that data will be analyzed, and it will be analyzed in a way where it, of course, provides a customer benefit, and that is all around personalization. The customer doesn't want to be a standard customer of a bank. He wants to get some personal services and some personal recommendations, where perhaps in earlier years he thought that he gets it at the branch within a personal conversation. Now this moves through data analysis in the digital space. So that's one big trend, everything around data. And it's a combination. The bank has to become more customer-centric.
Over the next few years, there's a lot of stuff going on. I really see that we now finally have the shift from offline, from branches to online. So it's everything. It's like all the processes need to be fast and automatic. The front end needs to be polished to compete with like Google and stuff. So it's not about having a beautiful branch anymore. It's like having a great user experience for your online services.
Well, our most exciting challenges is definitely helping banks to effectively create digital branches where they can, and when they can replicate the quality and experience of the physical branch environment using remote channels. The past few years has seen, unfortunately, bank branches closing in significant numbers, and the COVID pandemic has again, unfortunately, accelerated these changes. While digital and remote channels are picking up some of the slack, they are yet to really replicate it face-to-face.
So the challenges that we are seeing in the industry, that is exactly where we are positioned, is to support the incumbent banks to move forward, to incorporate new ideas, new working business models into their large infrastructure and their larger business approach. And also by kind of putting some technology on top of it that is more modern, because they will not change the basement, but putting some technology on top of it like Azure, being more flexible on the front end side, being more customer centric, being able to really address the needs of some segments within their entire user base.
Some of the biggest challenges that we see within the financial sector today is really around digitalizing the customer journey, like getting more and more customers to use the online universes of the financial industry, driving down cost on that side, but also delivering unique experiences for the customers through these digital channels. We've only just seen a little bit of what's possible. I believe that we're going to see in the future more and more unique value propositions that are going to solve issues for the customers in a digital way, and where there's very little human touch involved in both selling products, but also in making everything secure. So I really believe that instead of focusing so heavily on compliance as we've done the last couple of years, we can turn more towards what the customers are needing and building things for them in a fast and innovative manner as well.
There you have it. Seamless, convenient, innovative, fast, digital. These are the expectations of consumers today when it comes to any products and services.
In order to be successful, financial institutions need to know how to manage their failures. Things are changing very fast, and in real life, black swan events do happen. The way companies react to the latter makes the real difference between them. So keep calm, and when something goes wrong, use your imagination. That's what I'm actually thinking of. And here the second important thing is not to be afraid to experiment. Without research and development, there is actually no way to be successful and to be at the end on the successful side.
To address these high expectations, corporate startup partnerships have become increasingly important, and the COVID-19 crisis has especially shown the need of collaboration. With the crisis' drastic impact on consumer behavior, such as the light speed acceleration towards the need and adoption of digital offerings, the business environment for many established financial institutions has fundamentally changed. This will increase the importance of corporate startup partnerships even further, because corporations will have to address the customer need and quickly bring new products and services to the market by leveraging startups' knowledge and resources.
Financial institutions are shifting towards a cohesive, simple, and personalized customer experience. The panel will focus on how banks can take steps to offer innovative customer experience solutions to increase customer engagement and loyalty. Join us now to hear from influential speakers from Deutsche Bank and Railsbank, amongst others. It's my great pleasure to introduce to you the moderator of the very first panel of today, called Perfecting the Customer Journey in Financial Services. Please welcome publisher and owner of the papers, Mélisande Moal. Mélisande, can you hear me?
Yes, I can hear you well. Hi, Philip. How are you?
Hi, great to see you, and great to see you others as well. Mélisande, tell me, how did 2021 start off for you?
Well, had a great start of the year. However, slightly different than the other years. No opportunity to hug colleagues or to basically socialize. So that was a bit tough, I guess. But other than that, pretty good. Looking forward to another exciting year in FinTech.
And we're looking forward to an exciting panel with you now. Feel free to take it away, Melisande.
Yeah, so thank you for the introduction. And I'm very delighted to moderate this session with this wonderful panel. And I would like the panelists to introduce themselves briefly. Louisa, could you please kick off?
Yep, a pleasure too, and thank you for inviting me. So my name is Louisa Murray, and I'm COO of Railsbank for UK and Europe, one of the first employees of Railsbank here a couple of years ago, and background very much in finance, trading, and now FinTech.
Cool. Joris.
Hi, everyone. My name is Joris Hensen. I'm the initiator and co-lead of the Deutsche Bank API program that we have started in 2015 on the retail banking side of the bank.
Great, thank you. Michael.
My name is Michael Satur, and I'm head of research and development in Tatra Banka. I'm initiator of the several initiatives within the bank, and one of them is open banking.
Great. Brian, could you please introduce yourself as well?
Yeah, I'm Brian Harris. I'm the Chief Product Officer for the issuer and e-security part of the Nets organization in the Nordics. And I lead our product organization really in talking about what we're doing today, which is user experience and the capabilities that we bring to banks and issuers.
Sure. And today we will discuss the following topics in this panel. We will talk about open banking and banking as a service and value creation for customers and partners. We will talk about these new meaningful propositions in the context and channel that customers prefer. And we will talk about what it takes to select and leverage the right partners to enable these innovations and enable growth. So let's start with open banking and banking as a service and value creation. Joris, what is your experience in creating value for customers and partners through APIs? I mean, you've been in this business since 2016, if I'm correct, and maybe you could elaborate a little bit on your journey so far.
Sure. I mean, our journey basically started when PSD2 was still far away, when no one was talking about open banking. And when we started to talk about opening up, people felt as if we suggest to open the data center and everyone can just walk in, take the data out for free. So everyone felt threatened. But we felt like there's a huge business opportunity here, like a triple win situation for everyone when you talk about open banking, because there are great new services and products you can deliver to our customers. Our partners can address new customers, and for us as a bank, it's a potential new business model. So right now we have over 38 fintechs connected. We have developed more than 25 API products that go beyond the scope of PSD2 and that we call premium APIs. That include, for instance, not only account information, but also credit card data, saving accounts. We have an investment API, and we have now even banking products like an account opening. And I would say our journey was not only about technology, but obviously technology is a fundamental piece when you think of APIs, but also about building an experience for the developers, because they are the ones who should quickly get to use the APIs that you offer. And then on top of this, we work on building an experience for the business partners, right? Because also the product managers out there, or the product managers in the audience, they have to understand what can I do with banking data in my context, in my product. So we work on this and on smooth processes like a short onboarding processes to, on top of all of this, deliver a great customer experience, because at the end of the day, you want open banking products to be user-friendly and to seamlessly integrate in the life of customers.
Yeah, and Michael, when we talk about open banking, it started with a regulatory push, as Joris mentioned. It was basically PSD2. How did you convince the leadership to embrace this as a business opportunity and to go beyond the regulatory push?
Yeah, the PSD2 was the major thing in terms of open banking, not only Slovakia but all around Europe. And frankly speaking, when our board members saw the business case behind the PSD2 itself, they weren't very pleased with that. So that's one of the main reasons why we also open the new initiatives, how to be also proactive in open banking, and how to bring value to our customers, because regulatory push us to do something, and we can do much more beyond that.
We talked about open banking, but since I think it was 2019, there's also been a lot of talk about banking as a service or embedded finance. Louisa, if we talk about terminology, what is exactly banking as a service, and how does banking as a service differ from open banking? How do these two relate? Could also be a question.
Yeah, sure. So in terms of definition, banking as a service is basically providing complete banking processes as a service. So something we do, we give companies the ability to programmatically open accounts and make payments. So these are all provided by APIs and integrated with a licensed entity's secure and regulated infrastructure. So open banking was the catalyst for banking as a service and embedded finance. And huge momentum has been seen opening up the banking and finance world to these APIs. And it's the APIs, and I think that was mentioned earlier, that have driven the journey from open banking to embedded finance. So open banking itself was grasped by the industry as a term which embraced the sense of excitement and something's changing, there's change afoot. Yet really open banking is two services. It's account data and payment initiation, whereas embedded finance is about a huge amount more. So open banking, also with the ability to issue cards and accounts, currency conversion, multiple payment schemes, and collecting money. That's the really kind of sexy story.
And who are your typically partners, and what problems do you solve for the segments that you address?
Yeah. So Rails Bank itself, we prefer to become a direct participant of various global payment schemes and things like that, such as UK Faster Payments, yeah, and SEPA. But if we can't, so we're moving into a new geography, then we could potentially partner with a local bank, such as DBS is what we've done in Singapore, and that gives us access to those payment schemes. We can also, or we also partner with card schemes, Visa, MasterCard, we're a principal member, and they deliver debits, credit cards, which are linked to the accounts that we enable our customers to open. So really, the benefit we give to all of our customers is that we allow them to have the capabilities to prototype, launch, and scale at speed with one partner, i.e. us, and one integration, hopefully a simple integration.
Okay, that makes sense. Thanks, Louisa. Brian, when we talk about the UX or the customer experience, what best practices and approaches did you use or did you develop within Nets to really excel in this particular topic?
Yeah, I think what the other panelists have talked about is this sort of the enabling technologies. But at the end of the day, it's what you do with them that really matters. And I think that's what we focus on in terms of how we work with our financial institutions, which is here are a set of capabilities, and it could be APIs, it could be any number of capabilities, but how and what problem do you apply those capabilities to, and what is it that you're trying to solve? And I think the biggest learning we've had over the last number of years with UX, and I'm sure I'll offend UX purists that sort of talk about where UX sits in an organization, but our approach has been that at the end of the day, everything that we do with a product, user experience, is a fundamental and integrated component to that. So while we have UX individuals and team members, they are applied and a part of everything that we do in every part of our product. And so it's not a functional group that gets inserted at a point in time. Right from the very outset, when we start talking about what problems do we think we want to solve, right from talking to issuers who aren't our customers, and understanding the context of the market. Because I think if we really want to apply that sense of insight, you don't just do that at a singular point in time, you do that throughout. And I think that's probably the most fundamental learning of what's worked well for us.
Yeah, thanks for these insights, Brian. So if we go to the next topic, which is basically, well, some more depth on these meaningful propositions that are being built upon open banking, embedded finance, and the UX. Michael, I would like to start with you. What are the most promising new use cases and propositions built on the back of PSD2 and open banking for segments, whether it's consumers or SMBs or corporates? What is your Tatra Bank, which is the #2 bank in Slovakia? What are the most promising use cases you're currently working on?
Yes, we are a front runner of open banking here in Slovakia, and the majority of the banks were just regulatory compliant and they don't do much. And our use cases are like nothing extremely new. This is something which is already done in several markets. It's like connecting to the invoicing system, connecting to the accounting system, enable the reconciliation based on the APIs. And we are at the start of our journey, so we are going step by step. And these use cases, we see them as a low-hanging fruit, and that's the reason why we are approaching them as the first.
You mentioned a use case that I found interesting related to, for instance, loans for cars and how you could, add more value in the journey of consumers that are basically looking for a car, what car to choose. Could you elaborate a bit on that as well?
Yes, of course. Our situation in Tatra Bank is that we are able to provide end-to-end loan for new-to-bank customer within a minute. The fastest customer did it in around 6 minutes. So we see our proposition as quite attractive to be in the process of buying stuff, not to be a partial process like I need something and I need the money for it. So they are like two separate processes. So that's the reason why we are thinking about to provide this loan process which we are having as a service also to the third parties.
Yeah, it's cool. Louisa, if we look into examples of use cases that you offer or solutions that you offer to fintechs and to consumer brands, how did you help them bring new innovative experiences to their customers? Could you give some examples?
Yeah, sure. This is about, I can talk forever because we've got a couple of hundred different customers who use us. But I'll talk about a couple of more early digital native companies and then a brand. But we've got a company called Plum, who started with us about 18 months ago. So they're an AI-driven saving and investment app. And they use Railsbank's ledger system. So Railsbank's ledger system holds any fungible asset. And we also provide the licenses to them so they can enable open banking and savings automation. And it's all super cool, slick, and lots of different new products being launched every week. I use it, my university-aged children use it, and it's a brilliant little app for saving every week, literally. Another example would be a company called WageStream. So they're backed by social impact charities, and they allow employees to have instant access to their earnings as they earn it. So they've got some great customers, NHS trusts, some quite well-known restaurant companies, and obviously not so good at the moment. But it's all about financial well-being. So that's their guiding principle, and every single one of the products they launch upon us improves hiring and retention for their customers. So it's been really, really powerful. Then also we have quite a well-known supermarket brand, Sainsbury's here in the UK, and they wanted to bring a product to market and try something out. So literally just in a couple of stores, they wanted to try a top-up savings kind of product that they could potentially use, turn into nectar points once you've got a certain amount of spend in store. And they literally got up and running with us in 3 months, tried the product out. It wasn't their best product. They didn't necessarily want to issue it, but it literally gave them that proof of concept in a couple of months, which they know they'd never been able to do internally.
And how did this help them in their service towards their customers? What has been the win for Sainsbury?
Yeah, so what they wanted to do was at a certain time in a customer's life, they would maybe move off of Sainsbury's and go to one of the cheaper supermarkets when they had children. So what they actually wanted to do was encourage saving. So by getting people to save a little bit every week from the shopping they did, turn it into Nectar points, and actually give a kind of an interest rate as well to those Nectar points. So it was a little bit of a win-win for both. So they'd get to keep the customer, and the customer would get, you know, discounts and more points to spend.
Yeah, it's very much a loyalty instrument.
Exactly.
Yeah.
Yeah.
Great. Joris, I was wondering if you look into the new propositions that are being built with APIs. Some of the use cases are pretty new, both for the partners you work with and for the end user, whether it's a business or a consumer. So how do you bring these emerging new use cases to markets? What have been your learnings in that matter?
Yeah, I think it starts with the learning that it's really a two-sided market from our point of view. So on one hand, we have the partners who build the products, and on the other hand, we have the customers who are supposed to use those products. So in terms of working with the partners, I think it's true what Brian said. No, it really starts by understanding the context of the partner, the pain points. So that I think this is really, really essential. I mean, one of the learnings is it takes time, right? I mean, to dive into a certain context, but you really have to do this in order to have an early involvement, understand are the API products I already have, is it enough? Do we have to add the data in it? And then I also like this idea of virtual prototypes. We, for instance, had user testing, maybe similar to the Sainsbury's story, right? Where you can identify, will it work or not? So all of those are important elements. And then if you look on the customer side, I think no customer would say, yes, I'm looking for an open banking or embedded finance solution, right? So every customer wants to have something easier or maybe faster or anyhow. So, and I think open banking or embedded finance can really do it. But the question is, at the end of the day, the customer has to share the data, personal data. It doesn't matter if I'm a business customer or I'm a private customer, I have to share my data, right? So we have to build up this trust. This is something we learned. And we learned that it's not enough to put a logo somewhere on your website and claim, well, there's this interesting product, but we have to educate customers about the usage of their data, about the possibilities they have, for instance, where they are in a mobile banking app or in a newsletter. And for instance, we have a product helping customers to speed up the tax declaration process, where they can use their financial data to pre-fill the forms and make the process easier. So all of those examples that help them to understand, I think, the benefits of it. And yeah, but I think it's still a process, and the big learning is it's really a journey, product market fit.
Yeah, it's a joint journey, and I guess that's also new for marketeers in the bank to work closely with partners also on the marketing and get those propositions to market. If we talk about in the last 2 years, there's been a lot of debate on, if we talk about customer experience and e-commerce, on stronger customer authentication, which is mandated finally as of the beginning of this year. And there has been a lot of, fear and anxiety that this stronger customer authentication adds friction and therefore will impact e-commerce sales. I guess it's too early to judge. We can't tell yet, but Brian, you've been working closely with banks to get the UX in stronger customer authentication to get that right. Could you elaborate a little bit on the learnings of the user experience in stronger customer authentication, and also elaborate on the challenges for banks to get this right?
Yeah, I think similar to what Michael was saying in terms of there are those that have approached it very much, I'm just going to meet sort of the letter of the law from the regulatory change. And I think they've sort of sold themselves short in terms of the opportunity. And I think there are those that have said, okay, well, what does this mean? What is it trying to accomplish? And what are the implications for that end consumer experience? I think the bump and the pain along the way is it is difficult to coordinate both the merchant and the issuer, getting all of those things aligned. So I think that's where you're probably seeing some of the frustration and challenges right in the here and the now. But what we have learned along the way is it's sometimes a little bit surprising. I think issuers and financial institutions sometimes underestimate the power of their own brand. And I think in an e-commerce or context, I think it's important to think about friction, but it's also important to understand that not all friction is necessarily bad. And in that, I mean, we did a lot of user testing, and when you insert a checkpoint effectively into a consumer experience, and it makes sense to that consumer, right? There's some context around it. It's a large purchase, it's a new merchant, whatever it may be. And if it's backed by a brand inherently that they trust, i.e. their financial institution, then actually it was a really positive response from those consumers, as in actually they felt protected. And I think that's a really important understanding, that we don't sort of go in, I mean, you can go in with a hypothesis, but you do need to test that. Because what our experience has been is every one of a customer's expectations can be different, but you can sort of bucket them. And most of the time, if you've introduced checkpoints into these processes and it is in the context of something that the consumer would expect, yeah, that kind of makes sense that you're doing that. I think where the frustration lies is when those things are inserted and it doesn't make sense. So, you know, the example would be, I've used my card a number of times and all of a sudden I go to use contactless and it doesn't work. There's no information to tell me what's happened and I'm just frustrated. And I think here in the UK, what you see happen is that person takes the card, puts it back into the wallet, and they pull out another card to use that. That is not what you as an issuer want, because you're engaging them in multiple brands, which you as an issuer are losing out on. So I think it is really about being clear. You have to address the user experience in the context of what it is that they're trying to do from commercially. And I think that has been the main learning. And I think that surprised many of our issuers, that it wasn't perceived negatively. In fact, when you constructed it properly, consumers were appreciative of the check-in and the support and the protection that they inherently felt from that.
Yeah, I can also imagine that as a consumer, you're sometimes surprised, like how come the bank, you know, ask for a two-factor authentication with this merchant that knows me so well? Eh? Yeah. Basically, consumers sometimes overestimate the capabilities of banks to put all these different data points together in a personalized user experience. Yeah. So could you elaborate a bit on what is exactly being the challenge for banks and how can that be bridged?
Yeah, I mean, look, I think every one of the panelists on here could talk about what their organizations do to help bridge some of those things, because you're right. I think whether you call it overestimating what the banks are capable of or being underwhelmed by what the banks do with the data that they have access to, it's probably both. But I think it's important to understand that as a consumer, you know, we're sort of, I think Jörg was talking about, nobody wakes up in the morning and says, I'm going to use open banking today. They're doing something, you know, they're doing a payment because they're wanting to purchase something. They're wanting an experience, or they're wanting something. They don't think about the underlying rails. I mean, we love talking about this stuff, but at the end of the day, what I as a consumer want to do is I want to affect an outcome for something. I want to make some transaction. I want to get a mortgage. I want to do any of those things. And I think it is an enormous opportunity for banks to leverage partners that can help them bridge these things, because consumers don't think about the multiple organizational structures that sit behind the bank. What they think about is, today I need a mortgage, tomorrow I want to buy something. I chose to buy that, but you know what? Now I've got some cash flow issues. I want to turn that from a credit card purchase into a multi-payment over the next 12 months. And I think that's where banks have an opportunity to sort of use partners to help them bridge things that they're not capable of bridging themselves.
Yeah, and thanks for this last point. It also ties greatly into the last topic, where we will talk about how to leverage these partners, because banks are increasingly under pressure with the accelerated digitization, competition, new entrants, and yet they might not have all the skills or resources to build things themselves, or to bridge these gaps. So it would be great to talk about the partners that can help accelerate these partnerships. Joris, what type of partners do you need? And And how do you envision, or you or Deutsche Bank, and how do you envision successful partnerships? What are sort of the preconditions in partnerships that you prioritize or are important for you?
Well, I mean, we look for all kinds of partners. That is not limited to a certain industry, I would say. It's just has to be a data-driven business and a business where you could actually work with financial data. So it's more like, in a way of what you can imagine, what you can do with banking data in a context. And I remember lots of discussions we've had where we had no clue what we can do with banking data, and then suddenly you had a great idea. So everything is basically possible, and I think we differentiate between, like, you can say 3 types of partnerships. One is, I say, a technology or marketing partnership, because APIs, you can definitely, straightforward, you can integrate in your product, right? And then you just extend your product by banking data. And on top of this, you can have like something like user testing, like use the client base we have, send out newsletter, marketing, all sort of this. Then we are looking for reseller partners, I would say, in a way like, okay, we have the possibility to open up new banking products with the help of an API, so you can integrate this on a platform. It's also, I would say, pretty straightforward. And then last but not least, we have something API partner or data partnerships, where you can benefit of more data, or the premium APIs we offer on top of the PSD2 scope that you can offer to your client, or where you can bundle new products with. And I try and just mention it. I think it's you can learn so much from partnering. It's really something I feel too, and it's also from the very early days. We got the feedback. Okay, if you want to partner, you have to take it serious, right? So startups have worked with so many big companies where contact persons are changing, where decisions take a long time. So you really have to take those partnerships or deal with them very carefully, because time is precious for the small startup teams or the teams out there, right? Who could spend either the time with you or working on their products. So I feel like this is really important to keep in mind.
Yeah, thank you, Joris. And Michael, could you elaborate a bit on your strategy and considerations when choosing partners? What are things that you want to do yourself end to end, and where do you choose to work with partners?
I see a beauty of the open banking in this, that yes, we are thinking about certain partners, but basically every week somebody is calling us that we have heard that you are doing something like this, and maybe it will help us with this or that. And it's like, for me, the core of the open bank is that you don't have to invent everything by yourself, and you don't have to deliver everything by yourself. And every bank and every company has a limited resources and has limited priorities, or should have only one priority. And basically, the beauty of it is that you can enable another parties also to deliver the value-added services to your clients. So frankly speaking, our priorities are a little changing almost every week, but we are focusing now on the small business banking customers, and on the how to add the value also for the corporates. And the main reason is that we've got a certain limitation in terms of banking law here in Slovakia. So we cannot do everything what we can imagine. But this is something which can change, because also the legislation is changing as the new entrants in the market are available for the clients.
Okay, when we talk about Louisa, banking as a service and this development, some banks might see it as a threat, since partnering with banking as a service provider cuts them out of the as an intermediary in terms of the customer experience, and others choose to partner with you, while others choose to become a banking as a service provider themselves. How do you see banking as a service developing in 2021, and how do you feel about banking as a service as raising feelings so ambivalent?
Sure. So first of all, we don't think banking as a service should be seen as a threat. It really should be seen as an opportunity to provide the consumer with improved service, inclusivity, and everything they need. Some banks have obviously recognized this, Deutsche, for instance, but others haven't, but hopefully eventually they will. But for 2021 for us at Rails Bank, we really think that the ability to embed finance into apps and customer journeys and everything is the game changer. So we can allow, and other providers can allow, any type of company, whether that's a retailer, insurance company, or funky fintech, to build financial products themselves and different kind of use cases, so they can engage with their customers more than once a year, for instance, if they're an insurance company. So, that our aim is to be at the front of that revolution. I think we're fairly leading the charge. We've even got now a new Houston no-code platform, an Open Rails API, so you can embed finance and as easy as point and click. You don't even need to code. So we're super confident. Banking as a service is here to stay.
So I see Joris nodding. Any thoughts on that, Joris, or any comments?
Not just like the without no code thing, because I feel like it's so important. When we started to put out the developer portal, we thought like, okay, all the developers are just inventing it themselves, right? But I think it's so much about the product managers and so much about building quick prototypes. So I really like this no code idea and being able to build prototypes pretty quickly.
Great.
Cool. Last question for Brian. You work closely together with banks as Nets. What type of partnerships do you think can help banks to accelerate in the customer experience, and what are essential preconditions to make these partnerships work and successful?
Yeah, that's a good question. Look, I think all of us represent different types of partners to banks. I think the challenge for many banks has been, it can be a little bit intimidating to have, a myriad different providers of sort of specific capabilities. And so I think the aggregation of some of those is an important thing for banks. Some banks don't necessarily want that. I think many do. And I think one of the things that we do when we're really evaluating who we're partnering with, which is, just really be clear, what is it that you want to be really bloody good at? I mean, I know that sounds cliche, but we know when it comes to sort of that card infrastructure and that card transactional processing, what we want to be the best at. And then we're also clear, what is the value chain that banks are looking to partners to help them with? And so even if we don't build it ourselves, if we're sort of augmenting or extending our capabilities, we want a partner that sort of bought into that same belief system, and that we can integrate it so it is simple and easy for the financial institutions to ultimately manage. Because I think that's what can be frustrating for some banks, is that it can be quite overwhelming to deal with lots of different providers. And so the default tends to be, we'll just do it ourselves. So I think partners that can help aggregate those, and partners that can help banks understand where you can add value into their value chain without sort of disrupting what they're trying to accomplish as their sort of core banking capabilities. I think those are the ones that are tending to do well with financial institutions.
Okay, thanks, Brian. And thanks, Louisa, Joris, Michael, for your great insights. And also thanks to the audience to tuning in. I wish you all a great continuation of this Plug and Play Expo, and I wish you a great rest of the day. Thanks, guys. Hope to meet soon, face to face.
Thank you.
Thank you.
Take care.
Deutsche Bank is the leading German bank with strong roots in the European market and a global network. The bank focuses on its strength in a corporate bank newly created in 2019, a leading private bank, a focused investment bank, and in asset management. In the upcoming session, Plug and Play CEO and founder Saeed Amidi will be joined by Bernd Leukert, Deutsche Bank Chief Technology, Data and Innovation Officer. They will discuss the current situation and the future of digital strategy of the bank, partnerships and the landscape in the era of COVID-19. Gentlemen, welcome.
Wonderful. Thank you, Felix. It's great to be here at our Frankfurt Expo, and I am very, very much looking forward to our fireside chat with Bernd Leukert. I have a tough time pronouncing your name, your last name, but it's great having you here, and I very much appreciate you joining us on our Frankfurt FinTech Expo.
Yeah, Saeed, thanks a lot. I feel honored of being invited, and of course looking forward to the fireside chat in this virtual world where technology is helping to make it happen, as some health viruses are not allowing a face-to-face, a physical meeting.
Yes, and I really look forward to coming and seeing you in Frankfurt soon. You know, for our audience that may not be familiar with your past, can you please little bit tell us about your journey, your career as being a technology person for many years before joining Deutsche Bank?
Yeah, happy to do so, Saeed. So, as you said, Bernd Leukert, my name. I have been living prior to joining Deutsche Bank for 25 years in the software industry. After finishing my study of business administration, then with technical background, and then an additional year of software engineering in Trinity College in Dublin, I joined SAP. At that point in time, I would say a big startup. It had the culture which was different to traditional companies. So I started really my career as a software engineer, was coding, and ultimately was helping companies across 25 industries with solutions on becoming more efficient, in introducing new business models, in helping them to, I would say, to grow and to have an execution of their great business ideas, and not just locally, all over the world. And this was, I would say, a big insight. While technology is often the enabler, one fundamental learning in these 25 years is you have to understand the problem or the opportunity you intend to help towards your customers, whether these are big multinational customers or whether these are small local companies, is not making that big of a difference. And yeah, in these 25 years, having different responsibilities, and ultimately the last 5.5 years serving as a member of the executive management board of SAP, responsible for products and innovation, and towards the end of the career as well for the services delivered to customers. So exciting journey. And then I think when you turn 50, you have to reflect. Either you stay there until you go into retirement, or you say if there is a big opportunity, you do something different in life.
That's right. I'm very pleased to work with great companies in Germany like Mercedes, like Allianz and Munich Re, and of course Deutsche Bank. And many people tell me, doesn't matter what industry you are in, the technology part of your work is the most important part. And this challenge we went through in 2020 it showed that if you were not ready to work remotely and execute, it could have been a disaster. Do you agree that it doesn't matter if you're a bank, insurance company, or an auto company, how important is the segment of the technology and digital readiness for these industries?
Saeed, I think it's beautifully said. And I personally strongly believe that companies who are not leveraging technology, who are not leveraging the opportunities of digital, will have a tough time to have a healthy future. To the extreme, you could say either they have a monopoly, then okay, they can do whatever they want, then it doesn't matter. As there is not many companies on this planet, I would say technology is front and center for a healthy, sustainable, profitable future of small, mid-sized, but as well large corporations. And some people might say this was always the case. At least this is not new, since you were referring to the COVID situation last year. But I would say the role of technology has changed in a way that, whatever, 25, 30 years ago, it was more a cost center, enabling the automation of some back office processes. These days, I would say it is front and center and a key ingredient of the value creation the companies provide to their customers. So it's becoming a core element. And was interesting when I joined the Deutsche Bank, I said I want to get rid of the term IT. We should talk about technology, about data, and about innovation, and not as IT as a cost center, helping back office functions to become more efficient.
You are absolutely right. We have had the pleasure of working with SAP Lab, and I am quite familiar with your SAP facility here in Palo Alto, I think with over 3,000 engineers. Before, of course, joining, I'm in Deutsche Bank Lab in Palo Alto. I was wondering how important is it sort of bridging the gap between large technology companies like SAP and the technologies that come from startups, like a very familiar one that I would like to ask about next, Google, that it's like it was a startup, less than 2 decades ago, and they were 3 people when they came to our building on University Palo Alto. So I was wondering how important it is to work with startups that bring new technologies compared to large, corporations like SAP and Google Cloud.
I mean, let me start with a situation I was observing when working for SAP at many customers, a situation which I'm observing here as Deutsche Bank. There is always more opportunities and more demand on what to invest in technology, helping the business, helping all corporate functions, then there is a budget or then there is supply. Now, reflecting a little bit, there was a time when I would say companies said, I have to do everything on my own. If I'm not doing it on my own, then I'm not in full control of what I'm doing. And reflecting on your question, I think the opposite has proven that doing everything on your own, you cannot be the expert and the master in all domains. Therefore, the notion of partnership is the recipe for success. And you can, of course, discuss it from a technology angle, which requires that you overcome the not invented here syndrome, that you are embracing comprehensive end-to-end solutions and providing them towards the customers versus just focusing on your silo where you are good at and what you can offer to customers. And therefore, when you think of big tech companies like a Google, I think companies would make a significant mistake if they assume that they can provide the basic technology infrastructure in terms of scalability, in terms of elasticity, in terms of reliability, in terms of disaster recovery and many more aspects, doing it on their own versus consuming that as a service. But that's not, that is just, I would call it the traditional IT. When it comes to new technologies, think of a machine learning, artificial intelligence, think of natural language processing, think of many more things which are technology enablement of new business opportunities. Why should a non-technology company invest in own organic capabilities and compete with the tech giants of the world? And now the other aspect of your question, when it comes to fintechs, why not embracing the creativity, the speed, the agility of fintechs and incorporating fintechs in your end-to-end solution offering you are giving to customers? So do not consider the fintechs, the startups as your competitors, but open the kimono, meaning open an asset, and what is the best asset a big company can give is access to their customer base. At Deutsche Bank, it means giving fintechs access to 20 million customers globally. That takes some time in order to have this installed customer base and giving access to these solutions. And on the other side, what can a big company give in addition? It's kind of stability, it's kind of the proof point towards the customer that fintechs have a real value add, and bigger companies like Deutsche Bank have joined forces and are committing a solution towards the customer. So I would say on both angles, the notion of openness, the notion of partnership is the recipe for success. While, Saeed, that means a cultural change. That's probably easily said when we have now that fireside chat, when you are in boardrooms, when you are internal meetings, then you have to overcome that barrier of inviting even competitors and sharing assets with competitors.
Yes, in fact, you took the cultural change as a big part of success, because when I started Plug and Play more than 10 years ago, I used to only collaborate with CTOs and CIOs. And I am so happy to see on your title, you have Data and Innovation Officer, because innovation is about future and offering new product and new services to your 20 million clients. Whereas you still have to keep the data safe and keep the big organization functioning, but looking into the future and building new product, I think needs a new culture, especially in traditional companies, in, I don't want to call them dinosaurs, but in companies that are giants already. How do you go about this cultural change and the acceptance of new technology and working with fintech companies and startups?
I think let me refer to the word plug and play, because I love the term, and what is behind that term plug and play? It means if you really take it serious and if you really are interested in a partnership, then you are not living next to each other and say, I'm not fighting against you. You have to do more in order to overcome that cultural barrier, which means you have to work together and you have to be convinced that only a plug and play solution is ultimately delivering superior value to customers. And I can give you a few examples. As I was very interesting listening to you. To whom do you talk? Traditionally, like local banks, but as well multinational and global banks like Deutsche Bank have been talking to a CFO, have been talking to treasurers. If it comes to the corporate bank, of course, when it comes to private people, you talk to individuals about wealth management, you talk to individuals about their need for mortgage or credit. But what is the difference of a partnership? The difference of a partnership is that you are going beyond offering financial services. While you're talking, still we are in the financial service industry. And what do I mean with that? You have to have the internal conviction call, but then as well the related execution, that ultimately you want to have a financial service that is seamlessly embedded into the business model of your customers. So I give you a small example.
Please.
When the industry trend of selling machines is now flipping towards selling outcomes, and customers are only willing to pay per use. We are used to that in some areas. Take electricity. We have that pay-per-use model already established, but I predict that this model is kind of penetrated throughout all industries sooner or later. We have on that planet. In some areas, it is entering into a subscription. In others, it's purely outcome-based. And that changes not just the business model of customers from selling a product once, sending an invoice, and then getting a payment. It is resulting into micropayments whenever a product is used. And in order to introduce such a business model in a kind of efficient but as well profitable way, micropayments have to be embedded into the data flow of the customer. So whenever the data shows the product is used, and then you just have to agree, is it daily, is it monthly, is it weekly, is it quarterly, this should trigger automatic payment. And then what is the innovation? You have to agree on which data do you share between two companies, a fintech, a global bank, a manufacturing company, in order to provide that seamless plug and play towards the customers. If you are not doing that, I predict that huge opportunities will not resonate, as you cannot implement them in an efficient or in a profitable way. You can implement them manually, but then the idea of the new business model will not work. So that is the cultural change that you have to overcome, and you have to build trust, and of course as well you have to build controls. Trust alone is not making it. You have to permanently control as well, in the interest of your customers, that you are only supporting financial streams in case you have confidence and you have proof points that these micropayments are resonating. Just one example which we are introducing at many customers, which is supporting e-commerce business in many instances, and I could continue to share examples on that. And it would be wrong if we are doing all of that on your own. So just to close, we are as well investing in startups when there is an excess of liquidity, and at least in Europe we have a negative interest rate. So we have been investing in a startup in deposit solutions who is providing our customers opportunities to get positive interest rate on savings. But we are doing it by managing the customer onboarding process, everything which has to do with KYC. So giving customer a positive outcome, embracing startup technology and helping them to grow with a seamlessly integrated solution.
That is really, really fantastic. I believe this is your vision of the future of banking. And I recently read an article about one of your talks that Deutsche Bank is going to be a fintech company more than, traditional bank. And, these technologies are really bringing everything closer, like you mentioned. We saw that e-commerce and last mile delivery grew by factor of 2x in 6 months here in California. And can you tell me like other examples of how you are utilizing technology from Google Cloud or other technology? I heard you have other partnerships to expedite your roadmap and your future plan.
No, happy to do so. And I'm personally extremely convinced that banks in general have to become big fintechs and embracing technology to the maximum extent for internal own purposes, but going beyond as well, offering interfaces in a plug and play mode, and maybe even white labeling them so that the investment you are doing in dedicated services can be leveraged by customers, can be leveraged by competitors, can be leveraged by fintechs. One example is the currency fluctuation and the exchange rates. Why would you not offer FX currency exchange as a service towards customers, giving CFOs ongoing insight, not just in revenue in different currencies, they act across Europe or globally, but having the opportunity to see that immediately mitigated, if you want, even with currency FX hedging, as an additional service, but seamlessly embedded. And now going beyond, you asked what opportunities do I see with Google? When last March the Corona crisis hit all of us, what did companies do? They were just concerned about liquidity. And I would say most of the companies just took the credit line and asked for the maximum liquidity they could get. Not because there was an immediate demand for that liquidity, that was just perceived as kind of a safety net or a safety buffer. Those who didn't need it, by the way, gave it back 3-4 months later. But what was missing, and that is what we are addressing now in a project with Google, why not anticipating data streams and building an intelligent, smart model, predicting the future liquidity demand based on certain scenarios, which a system has learned from hundreds and thousands of events happening, and giving the treasurer, giving the CFO a more smart forecast on what liquidity they need. So this is a project we have been running with some companies in a joint collaboration with Google AI, and we call that smart cash flow forecasting.
That is great. I mean, I can tell you that you're speaking exactly my language. You know, here in California, especially Northern California, AI is going to change everything. But unless you apply it to a real world problem like cash flow and planning the future, AI by itself, it's just great technology. But when you apply it, it can really increase savings and improve productivity. You know, for our audience, if you had to predict 2021 and beyond, how do you see the future? Do you see it bright? Do you feel how long this little, I mean, it's not a little, it's a tough time, will last? And how can we help our clients to come out of this challenging times?
First of all, I think nobody likes extraordinary crisis situations we are in. And we all have to work together and team up to overcome this. But if you allow me a positive aspect, and that is the notion of accelerating the penetration of technology to serve customer needs, to protect the environment, and to utilize resources more efficiently. Whether these are financial resources, whether this is energy resources. So the whole notion of as a service came to a new understanding in executive boards, in the whole notion of APIs suddenly got attention, because if you just assume that there is capacity available, you do not have to manage compute, storage, network, machine learning, AI capacity in your own company and prepare yourself for a crisis, for a disaster situation. You are just consuming if you need it. And what one learning here at Deutsche Bank was, while I would say elasticity as well became a complete new meaning, because growing and adding is easier, assuming you have the capital or the liquidity. But adjusting then to the demand later, that's not that easy, because then you have the assets in your P&L. So, and I was simply using the change of the way of working, the working from home, explaining that, yeah, short term, we had to invest in servers, we had to invest in networks, and we did all of that by collaborating in the company, and we acted as one team in a crisis situation. But assuming we would not have to collaborate in order to get servers, in order to empower people in different locations, just think about if everything would have been already built for the next generation and consuming as a service. And I think that trigger was definitely coming from that crisis. So I predict that 2021, but as well beyond, has accelerated a lot of projects, a lot of strategies, and has accelerated especially the execution. Has accelerated as well the collaboration between companies, because you identified alone you will not make it. So teaming up, building partnerships, business friendships became a complete new meaning. And it's interesting that sometimes you need a crisis for that. So I see the future very positive, as we have learned to execute much faster. And why giving up that speed of execution? Many companies, including Deutsche Bank, has shown in these months.
I really, appreciate you giving plug and play couple of plugs in your talk and talking about future being bright and great, because as leaders in different industry, we need to remain positive and we need to look at the future, that it will be a much better world as we, use technology to enable us. And again, thank you so much in joining us in our fireside chat at our Frankfurt Expo. And I love to see if you have any closing remarks for our audience.
Saeed, let me as well thank you for the time. Thank you for inviting me and having me. I really enjoyed the dialogue and the conversation. And in closing remarks, I just want to share that Deutsche Bank is approachable. We are up for partnerships. We want to join forces and help our customers to overcome the current situation, but more importantly, to introduce future business models in a much more accelerated way. And that only works in partnership. Thanks a lot for having me.
Wonderful. Thank you so much for being with us. And back to you, Felix. Thank you. Thank you.
Thank you so much, Saeed. Thank you, Bernd Leukert. And what we've just seen really highlighted the importance of executive buy-ins. Now, next up on our agenda, exploring the impact of fintechs on wealth and asset management. Moderator of the panel will be reporter at Business Insider. Please welcome Rebecca Ungarino.
Thanks, Felix. I really appreciate it. My name is Rebecca Ungarino. I cover the wealth and asset management industries for Business Insider. We're based in the US with offices all over, though. And I'm so glad to be joined today by Aileen Matheson, Global Head of Insurance at Aberdeen Standard Investments, Nicole Curti, Partner and Chief Operating Officer of Stanhope Capital, and Octavius Mehe, Partner in Technology at Access Capital Partners. There's a lot to get to. I think I would love to start on sort of a more general note to set the stage here. And I'd love to hear from all of you on this, to sort of lay out your biggest goals and priorities as we do kick off the year. We're coming off of an unprecedented time. Stop me if you've heard that before. So maybe to start with you, Nicole, I'd love to hear really your priorities. What is most important to you at Stanhope right now for your clients?
Thank you very much, Rebecca, and hi, everyone. Yeah, we've acquired a business at the end of last year, which is based actually in New York, Miami, called Forbes Family Trust. So I think the main goal for us in 2021 will be the merger, to integrate the different teams and make sure that the communication channels over the Atlantic work well. So that will be the top priority for us. And as well, make sure that the synergies that are deriving from this will be positive for both the employees and our clients.
Sure. Octavius, how about you? You're in a different sort of firm. I'm curious what you have to say on that.
Thank you, Rebecca. Well, I would say that the start of the year is a bit tricky, and obviously one of our main goals is to understand the level of risks within our underlying portfolio and within our different strategies, because it's a bit more complicated to do this risk analysis exercise this time than typically after or during the global financial crisis. So for us, it's all about risk understanding and management.
Great. And Aileen, what about you at Aberdeen Standard Investments?
Yeah, well, to be honest, I mean, first and foremost, our priority is to support our colleagues and our clients as we, in many of the markets we operate in and operate from, we continue to work under lockdown restrictions. And I guess we feel as an active manager, we've got an important role to play in helping our clients and support our clients through this. So from a COVID perspective, emerging from that, that's really our top priority. And then obviously looking forward to June this year, looking to launch more ESG focused strategies and expand our digital advice offering.
Great, and we'll definitely get to ESG later, but you bring up technology, and that is my next question. I'd love to hear from all of you on this. I mean, technology and artificial intelligence is shaping really every corner of asset and wealth management in different manners, and especially as it relates to automation, say with digital wealth managers and the rise of those products. I wonder how you all view technology and AI and advances in that area in your own work and in your own work with clients. Octavius, maybe we'll start with you. How would you view that?
Well, first of all, I think that the asset management industry has been kind of a pioneer with respect to the adoption of technology, generally speaking, in terms of data management, data processing, and paving the way for predictive analytics and data. Obviously, today we have quite more advanced tools available for basically sell side and buy side players. To name a few, there is Microsoft Cognitive Toolkit, Google TensorFlow, Amazon and AI, and so on. And we've been basically used to processing high levels of data, high amounts of data for quite a long period of time. The main, and it's been also further increased by all the regulatory evolutions within the asset management industry. Now the main question is how does it translate in terms of value added for the end user? I think that we are still at very early stage in terms of predictive market modeling, real-time optimization of interactions with teams and clients. So the main changes are ahead of us.
Got it. And Aileen, how about you? How is technology shaping your work, whether that be new products that you're looking at or anything you have in the pipeline on that front?
Yeah, well, essentially, I mean, we've been in the last year, we've really been focusing on how we can evolve our digital advice offering, and particularly in the UK, with many a good few years now. You've had expansion of regulation to allow people to be more self-directed in retirement. So we've actually been investing a lot in expanding our digital advice offering to enable our clients. We found through our customer research that many of our clients aren't wholly confident about making their own investments, their own decisions, and we find that. People who have built up wealth tend to have financial advisors, but people who have savings through ISAs or their defined contribution schemes or whatever, they tend not to have advisors. So we've built a solution using AI and algorithms and so on that can actually, where the client can input most of their data themselves. And interestingly, we've actually found that they feel a bit more comfortable about doing that. They feel sort of less judged. They're more open with the machine. In the early stages, and then if they wish to, they can flip over to having face-to-face advice, which we can either deliver in person or virtually, on a screen. And so we're looking to expand that with the range of solutions and have some relatively simple investment solutions which are easy for clients to use as part of that.
And Aileen, one follow-up on that, is the idea that, at some point, people who were maybe building up wealth and using the self-directed product, that at some point they may be able to become a full-fledged wealth client, or that, down the line, you can lock them into a different service.
Yeah, absolutely. I mean that's also what happens. People, they have a sort of steady stream of, building up assets through, regular contributions to pension schemes, either through themselves or their employer and so on. And then, as they get older and get closer to retirement, then those pots become more accessible. They might, inherit some wealth through, intergenerational and so on. And so that's really important. And that's when you actually see that emphasis on advice, before retirement, but also once people have retired. And obviously, as they look into the future, there's no single point of retirement anymore. I think we all accept that point's passed. So they might be moving into second careers and so on. So that's where, I guess you would have more, potentially more advised solutions, but also, more of a requirement for some more simple self-directed solutions too. It really depends on the level of wealth the client has. But the fact is, the solutions, the digital solutions have got to, in my opinion, be able to offer the client that level of flexibility that they can be wholly self-directed, or they can ask for advice as and when they need it and have that flexibility.
Sure. Nicole, I'm really curious on how you view this at Stanhope.
Yes, so at Stanhope, the situation is the following. As we are an independent asset manager, we sit basically in between, banks and asset managers that very often have invested substantial amount of money to digitalize their solution for clients and their platforms. And we, obviously being a much smaller player, it is more difficult for us to, crack sort of the technology world. But we have invested quite a lot into technology over the last years, and we can see that there is a real demand, especially from the new generation of clients. The people that are between 20 and 40 years old, which is sort of the children of the clients that we are managing the assets for. Well, they have grown up with technology, and they cannot understand that in private wealth management, you don't have technology in place to communicate with the client. And myself, I'm personally very interested in all the new technologies, and I'm also sitting on a board of a company called We Can Group that basically is a startup that uses blockchain to improve compliance processes, which are the biggest headache for banks and private clients and managers like us, and use blockchain to basically exchange information in a very secure way. So technology, I think, in our industry, like Aileen and Octavius have said, are really at the heart of what we do.
Sure. And, moving on, to sustainability, and this is such a major component, I think, of a lot of what firms are looking to, at least in the US. I know that in Europe, it's a very different story, and you could argue more advances have been made in establishing ESG and sustainable investing framework. But I'm curious how you each view sustainability as a framework, as considerations when you are working with clients and when you are working with their money. So I wonder, Aileen, I would love to hear from you on this, how you are viewing sustainability at Aberdeen.
Yeah, well, definitely. I guess we have definitely seen a step up in the level of demand for ESG and solutions. I think from retail clients, that's definitely been accelerated through COVID-19, and people thinking more about the choices they make and I guess, the planet, climate and so on. And then for the institutional investors, I think that's coming from two areas. Obviously, climate transition and firms signing up to be sort of net zero by 2050 has been a real accelerator there. But also, we have many inquiries, and we're particularly looking at how we can use private markets to support impact investing. But a lot of our institutional clients in many markets are very interested in how they can use these types of investments to help their home tenants get back on their feet after COVID. So that's definitely there. But we've always used data. I mean, we've been an ESG investor for a long time, and data, particularly in climate, has always been at the heart of what we do. But what we've evolved in the last 6 to 12 months is to integrate climate considerations to create an ESG approach to strategic asset allocation and have the ESG embedded within that. And that's to help, manage climate risks and help our clients transition towards sort of the net zero goals. So that's really where we see the information and the scenario analysis, and we've partnered with Vivid Economics to create these models, and data is at the heart of it. Data and insight and intelligence is at the heart of being able to evolve these solutions.
Sure. And Octavius, I would love to hear from you on this. At Access Capital Partners, I don't believe that you have a dedicated impact investing fund, but it's certainly a consideration when making, many of your decisions. Can you speak to that?
Yeah, absolutely. So basically, Access has incorporated these extra financial criteria into all stages of our investment process since 2007. When we basically started our engagement program. Concretely speaking, we became signatory of the UN PR in 2008, and we have developed a 3-step approach to ESG integration, which basically covers due diligence, annual portfolio ESG performance monitoring, and investment analysis at exit. And we have a clear set of, I think, 14 KPIs we are using throughout the life of each investment we make. But as you said, we haven't yet developed ESG-centric investment products, but clearly there is a very strong demand for such kind of products on I would say all fronts, both from institutional investors and perhaps even more on the side of family offices. The main issue is what do we define as ESG, and particularly what kind of value added can be brought during the investment holding in the field of ESG. One last point, I think that in adopting ESG practices and gradually moving toward impact investing, the development of dedicated technology tools is also paving the way for a more generalization of this trend. And I think that for all asset managers, the two main mega trends are A, digital transformation, and B, ESG. So I think that at the end of the day, we will all have dedicated investment vehicle or investment products.
Got it. And Nicole, I would love to hear from you on this. At Stanhope Capital, I'm curious, what the demand you're, hearing on these type of products from clients and how you integrate it into your work.
Yes, thank you very much for the question. ESG has become really central to the way we have defined our investment process. It started a few years back where some clients, again, the younger generation, told us that they wanted us to look at investment not only from a performance point of view, but as well from a sort of impact and ESG point of view. So, impact on climate, on social, and how you could sort of influence companies to change their behaviors. And as Octavia said, we also were signatories of the UNPRI principles, and we have applied also internally. We have a footprint committee, and there is a real sort of ecosystem that was created around that to meet the client demands. And 2 years ago, or maybe 1.5 years ago, we have signed a client, which is a fully ESG mandate, which means we don't even report on the performance. They just want a reporting on ESG criteria, which is quite innovative because usually in finance, you would always expect that people want to look at the performance in terms of, performance money number and not only ESG. I would say there is one caveat to this entire ESG and impact investing theme, which is that a lot of banks or product manufacturers will sort of put that green label, it's called greenwashing on their products just to sort of attract more clients. So we really make sure that this is something that we really look after for our clients and try to avoid.
Absolutely, and I'm glad you said that, because that is, at least in the US, I know a major question, and just more broadly of, well, maybe we can come up with a definition that would be nice, and avoid the type of greenwashing that you allude to, which is certainly out there. Great to hear from all of you on that. And I would like to move on to switching gears to sort of how you are all dealing with remote work as it relates to bringing up really the next generation of wealth and asset management professionals. I know that it's just a very different environment than what you would have in the office with everyone spread out during the pandemic. I'm wondering if you can talk about what each of you have done and how that factors into the next generation of people in your firm. Aileen, I would love to hear from you on this as well.
Yeah, well, thank you. Thanks for the question. I mean, I'd say that actually one of the positives that's come out of COVID-19 is it's definitely accelerated the asset management industry being able to support flexible working. I don't think as an industry we were particularly innovative in ahead of others. Other sectors were much better at it than we were in asset management. So I think for me that creates the opportunity to bring a more diverse and inclusive workforce into, in the past, the asset management industry has been very city focused in London, New York, Paris, so on. And that's actually, that constrains, I guess, access to the talent pool and diversity within that, from the point of view of not just diversity of ethnicity and so on, but diversity of people coming from different industries into our industry. So I think that's helped. But the downside of that is certainly, I know our graduates and new joiners have found it challenging, you come to work in a new firm, a new career, and you can't physically meet the people you're working with. And that whole kind of coaching and sort of learning in a job aspect is particularly challenging when people are working from home. So we've been working particularly hard on making sure we have mentoring, check-ins, reaching out to colleagues that you ordinarily wouldn't speak to, just to kind of connect them and try to keep the community sense in the firm. So, there are some positives, but, without a doubt, it has been challenging to keep that community within the firm together.
Sure. Octavius, at Access Capital, how are you dealing with that?
It's a very good question. Just on a personal note, actually, I rejoined Access this year on the first day of lockdown. Obviously, if I had not been familiar with the company priorly, because I was recruited initially 18 years ago, it would have been quite difficult. Generally speaking, I think that we are just now seeing the real impact of remote working, because actually most of the investments, most of the deals made in the early month of the pandemic were actually started before we got this lockdown and multiple waves. And clearly one of the main constraints internally is how do you basically transmit, how do you deal with corporate culture, especially as Aileen said, with the new cohort, with the new people coming on board. It's much more difficult to define, to depict, and also to engage when you have only remote relationships. Luckily enough, it comes at a stage where we have robust technologies to do so. But I must say that I would say that most team members, especially the more junior ones, are really willing to get back to a more new normal. It's been quite exciting in a way in the first months of remote working. Now clearly we are in a business where face-to-face relationship is key. And obviously it's also very important on our fundraising side. At some point of time, our investors, our potential investors, need to meet with us, and it's been an important part of the fundraising process until now. So I would say yes, there is some gain in terms of productivity, but it's potentially more limited to what we would have expected initially. And a new normal would be a combination of the traditional way of dealing with management and clients, with the new tools which can facilitate some aspects of our business.
Got it. And Nicole, at Stanhope, I'm curious, what kind of opportunities and challenges, this time has presented to you. I mean, as Octavia said, deals are being done over Zoom, onboarding is being done over Zoom and other technologies. What's been your experience?
So our experience, I would say, is sort of twofold. There is an impact which is slightly different on employees than it is on clients. On the client side, all this crisis has helped us actually be much closer to clients and more frequently in contact, because you don't need to jump on a plane or travel across the city to meet someone. You can just quickly, send a Zoom invite and spend half an hour on a screen and exchange quite easily, as we're doing it now, actually. So that's on the client side. On the employee side, I would agree with Aileen. What is great is that it has a bit shaken up the traditional asset management industry, where flexible working was not really a practice that was commonly spread across the companies. So that certainly has helped. Now, as Octavia said, over the long run, you can feel that the working from home actually becomes a challenge for employees. So I guess that in the future, once the COVID pandemic will be over, probably companies will move to something which is a balance, but you will need physical presence. You need people to meet and exchange and sit together. It is different than just meeting on a screen or just working on, from home. Also, I think the working from home has brought its sort of problems, in the sense that you're bringing into your home, you're bringing work into your home. So there is no separation anymore. There's not more that moment where, it takes you half an hour to go back home and you can sort of tune down, which has been quite a challenge for several of our employees.
And as you can see, I'm in my very glamorous kitchen and office. So here, really, really helpful insight from all of you on that. And I would like to close out with something that I think has just been a massive discussion in the industry, and something I think our audience would appreciate, is the theme of consolidation. It's a different story in everywhere in the US and in Europe. But, I wonder how you all view this theme, what you expect to see going forward as far as consolidation in different corners of wealth and asset management. Aileen, I would love to hear from you on this first.
Yeah, well, of course, Aberdeen Standard Investments is the product of a consolidation, or a merger between Standard Life Investments and Aberdeen Asset a few years ago. And I definitely think it's a theme that will continue. I think, to be honest, what will drive it will be the type of investments that our clients are looking for. And by that, as I mentioned earlier, that obviously we're seeing an emphasis on impact investing, and definitely that plays towards the more niche and specialist managers. So without doubt, I think, even putting aside the benefits of scale and the pressures of fee compression, the requirement for the bigger houses to be able to offer, impact investments, which are effectively best served, a lot of the time through private market investments, then that should drive some of the merger and consolidation activity. And certainly, just before Christmas, we announced that we'd acquired a 60% stake in a warehouse, European warehouse logistics company called Tritax, and certainly that's driven by demand from our clients for that type of asset class exposure. So I think that will be the primary driver, as well as the economics and the market dynamics of fee pressure.
Got it. That certainly makes sense. Nicole, I wonder at Stanhope, how you are viewing that theme right now, and which, I guess, sectors of wealth and asset management you expect to see more consolidation maybe than others.
So obviously we are in the midst of a consolidation, because we, as I said at the very beginning, we just bought a US firm. I think in our industry, which is the independent asset manager, there will definitely be a consolidation over the coming years, because there are many companies that are of a sort of smaller size, and with increasing regulation and compliance, it becomes very difficult for smaller outfits to sort of manage to continue and be sustainable. So I think in our industry, we've already seen there have been a few transactions in Europe, at least happening. I don't know much about the US. So I think the trend will clearly be there, that smaller outfits will sort of pull forces together and try and create meaningful size companies.
Sure. And Octavius, how do you view this theme?
Well, actually, I think that the asset management industry is one of the most fragmented industries globally, with the top 10 players holding just 35-something% share of the market. And there are three drivers for consolidation: fee pressures, growing costs, especially with respect to the development of technology tools, as you mentioned priorly, and a desire for scale. So clearly there is a path to further consolidation in the market, and current context should ease this kind of deals. Now, consolidation does not necessarily mean acquiring companies. For instance, recently BlackRock has made minority investments in two technology platforms, and I think that this kind of less usual or less plain vanilla deals are likely also to occur, because it's always a challenge to fully integrate fragmented players with their own corporate cultures, their own tools, to entirely integrate them. With respect to Europe, I think the example of Natixis in H2O basically shows the limit of such kind of full acquisition, full integration. So in a nutshell, there is a need for consolidation, but it might not occur in the form of 100% full acquisition of players by other players.
That's a great point. I'm glad you brought that up, about BlackRock. I think they announced at least 2 deals in 2 years. eFront, I think was headquartered in Paris in 2019. And then last year, the Aperio deal as well. So I think those are great examples. And, it's great to hear from all of you on this. And I think that closes us out there. Great to be with you all today. Octavius, Nicole, Aileen, really appreciate your time. And I hope the audience enjoys the rest of the conference.
Thank you very much, Rebecca.
Thank you. Thank you. Thank you very much. Bye.
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 A big thank you to all panelists and of course to Rebecca for hosting the panel. Now next up we have the report on wealth and asset management and on how hyper-personalized products may actually be shaping the future of wealth and asset management.
The wealth and asset management industries finished 2019 on a high note. The early 2020 opened a new chapter of economic challenges due to the outbreak of the pandemic. Both industries have faced significant crises throughout their histories, and they always found ways to radically transform themselves and emerge stronger than before. Over the past 20 years, personal finance wealth has withstood the dot-com burst, the 2007-2008 crisis, and many more. And nonetheless, it tripled in size to $226 trillion in 2019. The industry is facing steady shifts in its customer base, with retail clients gaining more and more importance. In 2019, it represented the fast-growing customer segment. In 2021, wealth and asset managers will need to find ways to evolve and embrace emerging opportunities once more. Now, more than ever, they are supported, but also challenged by many fintech solutions. Fintech startups are taking advantage of many end customer preferences, their expanding technology and capabilities, and the increasing pressure on fee and cost structures. Today, we, together with industry leaders and challengers, want to shed light on some of the trends that will shape the future of wealth and asset management.
My name is Nikita Iyer and I work for Machts. Machts provides one-stop digital channels for doing business. So essentially, it's a destination, a one-stop experience for customers to receive premier service from an organization in their pockets, wherever they are, anytime, any place.
I'm Simon Forte. I'm the CEO and co-founder of Sesam, and we're a company specializing in big data and AI for investment. We work for banks, hedge funds, and private equity firms, and we extract billions of information from the web and let users generate analytics on their portfolio of companies or other financial assets using AI.
Hi, my name's Tom Kozlowski. I work for Delio as a client director in London, England. At Delio, we help future-focused financial institutions provide them with the technology, connectivity, and expertise they need to power their private markets offerings. We help them work in private markets more efficiently with less regulatory risk and help them to grow revenue.
And I'm Federici. I'm the CEO and founder of Abaca. Abaca has built an economy application, basically, and a seamless data exchange platform for our clients. We enable enterprise clients, our financial institutions, to access customer data, build insights on those data, and build intelligence through our conversational AI and next best action to help them create hyper-personalized experience.
So my name is Tiffany Saltini, CEO at NeuroProfiler. NeuroProfiler is a solution to assess investment profiles through behavioral finance and gamification. So we offer 5 different models: client suitability assessments, compliant with MiFID II and LSFIN, ESG profiling, financial recommendation, financial education, and finally, behavioral prediction.
Now that you have met our 5 amazing startups, let's see their thoughts on the state of the industry and how they can assist you in preparing for a more digitalized future. First, it will be crucial to further develop digital experiences and intertwine them with a human touch. Modern investors are looking to manage the money in the same way they conduct with their everyday lives, in a simple way, and using a range of digital tools and mobile apps. To be successful in the future, industry players will have to develop world-class digital consumer experiences that go beyond financial performance.
So in Maxtra's experience, we built a product that can lend itself to a number of different use cases across industries and across the financial services industry. Because the experience is about providing a means for you or I as a customer to simply open their device of choice, anytime, any place, and open a portal experience under the organization's brand that they're working with, which is personalized, private, and premier, because most importantly, it's persistent. It provides them with the history of all the conversations, interactions, documents, and complexity in the back and forth. And currently that process is cumbersome, tiresome, and not easy to manage for the client who's going through 5 different tools to look for where they last left off with their designated advisor. And so what Machts provides is really a one-stop digital channel. It's a one-stop experience that makes it extremely easy and convenient for an organization's customers to do business with them on their time, anywhere, any place.
So Neuroprofiler will help people to invest in 3 different manners. First, we increase the number of dynamic risk profiles thanks to our behavioral finance algorithm, because people tend to underestimate their risk preferences in traditional questionnaires. Second, we give meaning to their investments through our ESG profiler. And finally, we allow them to invest in more diverse and more suitable products thanks to our financial education platform.
Abaca enables wealth advisors to reach out to their customers in a personalized way and to build better insights and intelligence by using AI. And that's not it. They also develop solutions with retail customers in mind. For instance, they have built a digital savings platform and retirement solution for HSBC, which covers the entire life cycle of their clients from a very young age all the way to retirement. This solution not only created much higher engagement, but also provided the bank with a much better customer insights and a strong competitive differentiator.
And to further improve that personalized engagement, we've built our second product, Conversational AI, which is a human-like conversation through the chatbot, leveraging our natural language processing models, which enable individuals to ask any questions they may have at any time through any channel, through any chat system, really.
But are retail customers actually using chatbot solutions to help them with the financial questions?
If you look at the chatbot, most people are spending on average 7-8 minutes session time on the chatbot, asking those questions where they need answers. It's really interesting because, for example, we have a product with Legal & General. It's a chatbot designed for people that are age 55 and plus. So specifically, that product is only sold to those to this segment, and we see a huge interaction on the conversational AI, on the chatbot, and so there is a misconception basically in the market that says, chatbots are only for Gen Z or millennials. That's not true. In fact, from the research we did and from the results we have on the user base, you can see that the baby boomer and people that are older really enjoy having the chatbot. They can have a private conversation. They are not being judged. They can ask as many questions as they like.
And though the younger generations may be drivers of new technology like this and may be pushing the standard usage of apps in the market and that kind of way of living driven by messaging, social media, I think there's a strong misconception that the older generation does not appreciate this. Because in fact, I would argue that in most cases in banking, like in financial services and wealth management, in corporate banking, in family offices, in RIAs, the people who have the money to be getting that kind of service are of the older generation. And in fact, they're the ones pushing for this. And in fact, I would argue that some of the biggest adopters of this kind of technology in our cases has actually been the older generation, because these are people who their most limited resource really isn't money, it's time.
Now, our solution is definitely adopted by more senior clients. Most of our clients are private banks. And we have 80% of satisfaction during our pilot with private banks, and the average age is 65, 70 years old. So we adapted our solution to have different levels and different types of gamification based on our final clients.
We've seen that the digital divide has been breached and all generations are pushing for more digital services. Could technical advancements such as conversational AI replace relationship managers entirely?
So what has changed today is the tools and the capabilities we use to deliver that service. But people still expect the personalization. And especially when it comes to people's money. why they're paying your organization, that huge fee for your services is for your knowledge. It's for that knowledge worker's expertise. So the way we like to see AI at Moxtra is a little different. I don't see it replacing the human being for a long time, but I see it assisting the human being. For example, I think there have been amazing advancements in the space of bots, and we have clients ourselves who say sometimes our end clients have very small questions that don't require their advisor or a knowledge worker. So this could be handled by a bot in that same conversation digitally. But let's say that question gets more complex, it'll immediately notify the relationship manager and bring them right into the conversation so that the AI can basically be an assistant to that human being. And that is really where I see it going.
Now, is technology, or in particular conversational AI, going to replace the private banker? I don't think so. What we see clearly is, on one hand, when people want to have a private conversation and make decision on important product or whatever impact their life, they want to talk to someone. There is an emotional factor there, and then there is empathy, and there is the relationship that you have with the person you're talking to, which is really important. And so that's not going away, right?
In the future, the interaction between the client and the financial institution will not only be characterized by being omnichannel, it will offer humanized digitization. That means the intertwining of AI and personal relationships to increase customer engagement and satisfaction. Moreover, the digital divide between generations has been breached, and all clients are expecting seamless, digital-first solutions when managing their wealth. Next, we want to take a look at the products offered by wealth and asset managers and how they will change. The industry future customer base will be highly diverse, and thus, off-the-shelf products will not be sufficient anymore to satisfy investors' needs.
The new generation is very entrepreneurial, wants to have a greater say in what they're investing in, how their money is being placed, and so on. And quite often wants to take a much more active role in the management of that, which technology affords them the chance to do.
It's primarily, of course, leveraging machine learning models, our next best action, which are hyper-personalized messages to retail customers or to the advisors themselves. And that's really designed to help them understand what are the next best action people are interested in. And so by gathering data on your customer, which are personal data, behavioral data, emotional data, social data, financial data, health data, you're able to create that data profile of that individual, that persona, and you're able to use those behavioral natures to activate and engage those customers.
Moreover, financial institutions can also expand and differentiate their offerings by expanding into new market segments.
I think when you look at traditional wealth management and asset management today, offerings are increasingly becoming commoditized. And there's a sense of where technology is being introduced, you really have to make it work for you to help differentiate your firm and differentiate your offering. When you look at the private market space, that's in particular becoming a differentiator for a lot of firms where they can efficiently offer private access to private markets and intelligent services around that. But really, rather than just rely on technology or digitization, take an omni-channel approach.
A much more diverse customer base will challenge wealth and asset managers in the upcoming years, but also expanding into new sought-after markets prove a worthwhile endeavor. Wealth and asset managers are facing increasing pressure on existing fee and cost structures. To face this challenge, they can resort to emerging technologies to improve operational processes and drive efficiencies. This is specifically important in times when asset-based fees represent a significantly larger share in wealth managers' total income than only 7 years ago.
Yeah, when you look at our solutions at Delio, they fall into three main areas: technology, connectivity, and expertise. The core of that is really technology. So the helping clients digitize and optimize their private markets workflow across origination, distribution, the management of transactions, and reporting post-transaction as well. Naturally, not all of our clients use our technology for all four parts, but what we've done is, and what we always aim to do, is create end-to-end solutions. On the connectivity side, we're able to offer access to a broader network and help people reach other institutions that are focused on private markets, tap into integrated marketplaces, whether that's for investing in early stage companies or impact investing, and also leverage plug and play propositions where clients want to get access to a ready-made product shop. On the expertise side, we can do everything from helping someone design and test and launch a private markets proposition from scratch, through to solving specific parts of the issues. So whether that's providing regulatory services or structuring services to create market access so that investors can invest with lower minimum investment sizes, or trade securities across different jurisdictions where they might not have been able to otherwise.
However, digitization not only reduces cost, it also assists in making better, more informed decisions. With the chaotic state the world is right now, the need for data has drastically increased as people are trying to understand what's happening right now to the economy and to the individual portfolios. To be able to cut through the noise and gain actionable insights out of this masses of data, financial institutions from around the world rely on SESAM.
There are three things that we tackle. The first one is more performance. So the ability to find investment opportunities, to invest in the right company in a specific sector, to invest in the right asset class during a period, to invest in the right security specifically. So the fact that there is more information means that there is a higher potential benefit for our clients, which is something that we can measure also directly when they use the system. The second one is less risk, and that's especially relevant when considering environmental, social, and governance risk. We track dozens of different risks in real time on the web and can raise any kind of alert on what's happening on your portfolio company, whether it's a very large listed company or actually a very small private company that you have in your portfolio and that you may wish to identify in the context of a scandal or environmental responsibility. And the last thing is gaining time. All of that is typically work that is done internally on a project by project basis by firms. We automate all of that, and our clients can just leverage our tool as a standalone solution and directly build these kind of use cases in a few minutes or a few hours rather than months or years.
It seems like the future of wealth and asset management industry is highly automated, maybe even fully automated. Let's hear what our experts have to say.
I think the future of asset management is not fully automated. I think the need for people that have knowledge about companies and sectors is essential. We're working with both worlds. We're working with fully automated hedge funds that are trading based on purely on mathematical models, and we're providing factors and data that make sense in these models. But a lot of the work that we're doing is with companies that are making a decision based on human analysts analyzing a market or a company, and we're just providing additional insights, real-time insights, and things that are either too deep or too broad to be analyzed by human beings.
As we have seen, collaboration with emerging technologies can not only help you reduce costs and drive revenue, but also take advantage of the masses of available data to make more informed, value-generated decisions. Our deep dive into the future of wealth and asset management industries has shown us that to be successful in the upcoming years, industry players need to establish an omni-channel presence and drive humanized digitization. They will serve a much more diverse customer base with hyper-personalized products, available exactly at the right time. And lastly, they will leverage emerging technologies to not only drive revenue and improve margins, but also augment their decision-making capabilities. Summing up, we want to close this report with 3 recommendations from our experts as to what they think is most important when crafting a digital transformation strategy.
I think what's important for financial institutions to succeed in the future when you're looking at technology is being ready to accept change, but also attacking change and doing it proactively.
I think it's extremely important for today and tomorrow's financial services firms to realize that when they're building their digital roadmap, most importantly, it needs to be customer-centric. It's very easy to lose sight of who's walking through your door and paying you for your services.
I believe the first step for corporates that really want to establish a digital strategy is to think in terms of global strategy rather than a team doing POCs and testing everything that exists on the market. So having a clear guidelines and a clear process in order to source relevant technology and to achieve an actual goal is really key. And another thing I'd like to share is that I don't think people realize where this is going, where AI actually in the corporate world is going. We're at the very, very beginning of what's possible. We're just scratching the surface. We can go much further than that. We can do a lot more than this. And this is a true revolution.
So in our next keynote, our guest will be giving us first-hand insights on the new challenges asset management is currently facing and maybe what kind of opportunities lie within these challenges. He's Managing Director, Wholesale Asset Management for Germany, Austria and Eastern Europe, and he's Head of Innovation, Strategy and Fintech for Europe at Fidelity International. Please welcome Christian Machts. Hi, Christian. Thank you. We can say hi like this.
Say hi.
These days. Christian, great to have you here. It's a pleasure to have you speaking. How did 2021 start for you?
So look, it was a bit of a slow start. So I took a break and I tried to recharge batteries after a very challenging 2020. And we are off to a good start.
All right, and we're off to a good start of your keynote. Feel free to take it from here, Christian Machts.
Thank you very much. Look, and first of all, a very big thank you for having me. And it's really a great pleasure to speak at your conference here. And what I would love to do over the next 15 to 20 minutes is to talk, first of all, a little bit about asset management, our business model, what drives us and what makes us maybe a bit special. So then let me talk about the challenges our business is facing. So challenges which are already here and challenges which might come over the next couple of days and years and weeks and whatever. So, and then of course, and that would be the key point of my speech today, I would love to invite you to talk to us. I would love to invite you to partner with us. I would love to invite you to share good ideas, insights, technology, creative thinking with us, because I think asset management globally is desperately needed. But let me start by talking a little bit about asset management first. So asset management itself is a relatively simple business model because what we do is clients trust us with their money and we take that money and invest it on their behalf. So that means we think about, okay, what is the right style of investment? What is the right type of investment? What is the right security to invest in? So we put a lot of research behind. We're trying to understand markets. We are trying to understand environments. We're trying to understand political situations. And then, of course, we try to do the best we can with our clients' money. So this is our fiduciary duty. And finally, that's it. So this is where asset management was founded as a business just 120 years ago. So there is not a very long tradition of asset management. It's just shy of 120 years. It, of course, came from the US, and some of the companies which were founded at that time are still existing in the US and are doing pretty well. So, and of course, for all of that, so for investing our clients' money, we get paid. And when you look at the sheer size of our business today, so then on a global basis, asset management is now managing around 90 trillion in assets. So think about that number, 90 trillion in assets globally. Or when you would like to have a European view, it's 25 trillion in Europe and just north of 40 trillion in the US. So relatively impressive numbers. And of course, you also would be highly interested on revenue margins. So our revenue margin in the global business is around 26 basis points. So that means we talk about roughly 230, 240 billion of net revenues every single year generated in the asset management industry globally. So I think that's definitely worth having a look at. And that's definitely worth thinking about, okay, what are the major drivers in that industry? What we are facing right now is, of course, first of all, declining margins. So when you look at the 26 basis points I just mentioned, so that was 29 basis points just 5 years ago. So imagine what that means in terms of declining margins over time, and it's getting less and less every single year. And that's, of course, one of the key challenges for our industry. But where does it come from? It comes from, on the one hand, from new products entering the market. It comes from a shift of money in terms of from new ways of investing, but I will talk about that in a second. So what helps us? And there is one major driver. So when you look at the year like 2020, where you think, okay, wow, the pandemic environment has definitely hit the economies worldwide. So how has asset management done? So in asset management can look at one of their most successful years in history. So this is not because of the pandemic environment, this is because of the low interest rate environment. When you think about central banks across the globe, so they have leveled down interest rates in the same way as we have done in Europe some years ago. So, and that is really one of the strongest pushes for asset management. But before I close on our business model, I will talk about two things. Number one is culture, and why asset management is not something that is easy to copy and is easy to come in with. So the barriers are relatively high. So, and one is of course the sheer size of the business, one is infrastructure, but one is really the culture. And we are extremely proud on our culture because asset managers traditionally think exactly because of their fiduciary duty, very client-centric. So that's not always the case, but for most of the companies, including of course Fidelity International, I would assume, that is really the core of everything. So thinking about clients first, thinking about what to do with their money, thinking about a fiduciary duty is really key for us to do. So beside that, I already talked about it's a relatively simple business model. You don't need much equity to really run the business, different to many other parts of the financial industry. You have a simple balance sheet. You don't take risks on your balance sheet. So you only have costs and revenues on your balance sheet, and the costs are mainly in the IT sector, people, and of course running costs. So the last decade was of course one of the strongest decades for asset management in modern history. So when you think about the assets itself, so they have tripled over the last 10 years. That is of course mainly driven by the low interest rate environment, but it's definitely something to watch, and not to come to the conclusion too fast, but I think we expect that will continue for probably another decade. We'll see where. But, and there's always a but in such a thing. There are of course trends that really put pressure on our industry, that really drive innovative thinking and things like that. And I will talk about 3 of them. So the first one is of course passive. So passive, some of you have heard about ETFs, some of you have heard about index mutual funds, that type of things. So the whole idea of passive was introduced in the early 90s in the US. So, and then was parked for roughly 20 years. Nobody really looked at that. But towards the end of the early 2000s, that really became one of the hottest topics in our industry. So, and today, passive is just 20% of our overall market. So imagine from nowhere to 20%. And 20% means 18 trillion in assets globally. But, and this is the issue with it, it just generates 6% of the overall revenue in our industry. 18%, 18 trillion, 20% of the assets, 6% of the revenues. So we expect passive to continue to grow at a CAGR of 10%. So it's a relevant topic and it will be even more relevant going forward. So what does passive do? Passive is nothing else than taking an existing index, stocks, bonds, whatever you can think of, and just replicating that in a simple product. So you want to invest into the German DAX, you want to invest into the Euro stocks, you want to invest into something else. It's the easiest way to get exposure to stock markets, to fixed income markets, to other markets. So, and that idea were initially born in the structured product industry. So it's coming more from the investment banking side of the business and then swapped over into the asset management industry. And when I look at passive today, passive is more a technology than a product. So it's just the simplest way to get exposure to a market or to whatever you want to invest in, and this is really how we think about technology, less than or more than just product. And there is just a simple phrase which we repeat from time to time. So that means in our industry, what can be ETF'd will be ETF'd. So whatever doesn't add any value at all. So no additional performance, no additional risk mitigated, something like that. So that will be automatically ETF'd and you just invest in the simple stock market. So we still see some of our competitors in the market fighting against passive, saying, okay, that's not reasonable, that's nothing you should do. I think we should accept that passive has changed our industry in a massive fashion over the last 15 years. And of course, it has some advantages. It is exchange listed. That means you can trade it theoretically 24/7. So it has a very low price point compared to traditional products in our industry. So the target audience was from day one retail and investors. So it was really focused on that one. So, and that has helped companies like Vanguard or BlackRock to grow massively. When you look at their sheer size of the business, it's impressive. But what does it tell us? It's a very simple idea and it led to massive disruption in our industry. And clients have adopted to it. Of course, there is rarely an asset allocation today, either strategic or tactical, which exists without any passive exposure globally. So what is the second driver? The second driver is alternatives. So alternatives, think about it like private equity, infrastructure investments. So as the definition said, very illiquid, very different to just buying a simple stock at the stock exchange. So, and when you look at assets and revenues, so it's just the other way around. It's the flip side of it. So alternatives just represent 16%, 16% of the total revenues, of the total assets globally, but they represent 46% of the overall revenues. So this is where you make money. This is where higher margins are generated. This is really where companies are focusing on, because number one, it will continue to grow. Secondly, it is highly profitable. So really something to check. So why is especially the private equity space so important today? What we have seen over the last 10 years is a shift in value generation for companies. When you think about a new company is launched, so then you have a pre-IPO period where some value is generated, then you do the IPO, then it's publicly listed, and then you generate a value on that end as well. So reality is that company will do their IPO later in their cycle. So that means the value generation pre-IPO is even more important and even more relevant for investors than when it is publicly listed. So that is one of the reasons why private equity is so in scope. But when you think about illiquid alternatives, then we talk about complex product, normally intransparent products. We talk about products with a heavy paperwork involved in investing into it, holding it, and selling it down at one point in time. So we talk about minimum investments. So in our own case, we are offering some of those products where minimum investment is 5 million. So who in the retail space can afford 5 million to be a minimum investment in such a product? So this is something where we also look at technology to tackle it, where we look at infrastructure to help us with. And when you think about like companies like iCapital in the US, so they started business in 2012 to become the infrastructure for illiquid alts in North America. So, and just shy of 8 years, they made it to 65 billion of assets on their platform and to the market leading one in the US. And that's probably something to look at for the rest of the world as well. Let me talk about the third and last driver. There are, of course, many more, but let me talk about the last in my view. That is around a topic called sustainability, and you have heard about it. So sustainability or ESG. No doubt, that is something that fundamentally changes our industry. First of all, from the pressure from people on the street. Secondly, of course, from the regulator. So when you think about just here in Europe, the regulator puts so much pressure on that topic, and he or she, however you will call it. So the regulator uses the asset management industry to route the money into sustainable investments, to make sure that by setting the right regulation in each and every country in Europe, that will be in scope. And to be very honest, sustainability in the first place is a data challenge. So sourcing the right data, getting the right data together on a single stock, on a company, on a business, on a fixed income product or whatever it is, and then aggregating it onto a fund level, that's highly, highly challenging. So, and we believe that there is so much room for creative ideas, new business models, new technologies to tackle that data topic much better than the offers which are out there today. So when we move on in thinking about the business model in asset management, then of course there is a challenge around IT infrastructure. So only a few asset managers have made IT infrastructure a competitive advantage. So, and when you think about IT infrastructure, then you think about portfolio management systems, you think about settlement, you think about risk monitoring, you think about reporting, and many, many other functions which an asset manager is delivering to clients or delivering to the market today. And of course, it is normally a very sophisticated infrastructure. It's a high-profile infrastructure. It's not easy to deal with. And I think a good example for a company who has done well in that space is, of course, BlackRock with their Aladdin infrastructure. So they made it really a profit center. They invested heavily into that, and they are running their business, and many other companies running their business on the Aladdin infrastructure. But there are other tools in the market. And of course, as an asset manager, you look at the opportunity to add further capabilities, you add further products, you add further ideas, you add further services to your platform by adding additional companies, business models, and things like that. And you might recently have seen the announcement around Hub, where companies like PIMCO, Microsoft, McKinsey join forces in developing an asset management infrastructure that should revolutionize the operational system in our industry. We'll see where it ends. But again, there's a lot of room to partner in that space. There's a lot of room to think about system infrastructure, more efficient processes, settlement, and any type of client interaction in that space. So, but let me come back to the question, why is that all important? So when you sit in an asset manager, then of course you feel that over the last couple of years, also client demand has fundamentally changed. So while in the past, and literally over 100 years, the outcome of asset management was a product, a mutual fund, a passive product, whatever it is, or segregated mandate. And you have answered every single client question with a product. So, but those times are over. We are coming to a space, and I think in our industry we call it solution-oriented focus, where product is not the answer to everything, where your clients have very specific requirements, very clear asks. If they are thinking about a pension fund who does asset liability manage, thinking about a retail fund who is for retirement and deals with that very long-term challenge, things like that. And you as an asset manager today need to answer that question by putting the investment solution, by putting technological infrastructure, by putting marketing, distribution, communication, reporting, all those services together and tailor that to your client needs. And that is something to do at scale, highly challenging, because of course our industry is a product-centric industry, thinks about a single portfolio being wrapped in a fund and sold. And when you have that philosophy in your infrastructure, you of course need to change a lot of things to enter into the solution space. What we have done at Fidelity, for example, we have launched an initiative around asset management as a service. So where we have started to deconstruct our value chain, where we have started to think about, okay, what are the services in our value chain that can be carved out and offered to clients separately. So a very interesting thing, and of course, something to move on. So, but there are more services required. So when you think about just interacting with the end investor, interacting with clients. So we have a partnership, for example, with a reporting Fintech. So that helps us to report to every single retail end investor. And we talk about hundreds of thousands of end investors, so in a very individual fashion. So we know exactly when that client invested into our product. We know exactly where the product stands, what's the performance, so, and what are the preferences in terms of consuming reporting from us. So that's all measurable, that's all tailored. So when you think about just a client who has bad performance, of course we can change the music on the video, we can change the speaker, we can change the language a little bit. If the performance is positive, you can do it in a slightly different way. And so you really can tailor to the product, the outcome, the client. And that is something where, of course, we will need help going forward. We will need help and infrastructure to deal with that. All right, so let me talk about just our industry in a nutshell. Number one, as we have seen, it's a pretty mature industry, but it's growing. And it's a massive industry, talking about the 90 trillion in assets globally. So the demand in our industry is changing. It's changing into a more complex space, more solution-oriented, more tailored, more individual, customized space. Products are changing too. So we talk about more passive, so the rise of passive is unstoppable. We talk about alternatives in very different fashions according to client segments and groups. And we are highly challenged on our home turf, which is around active equity, active fixed income. So that is definitely something which will stay, but will it grow? I don't know. So there's pressure on pricing coming from passive, coming from other parts of the industry. So means we are losing literally 1 basis point of revenue margin every single year. So when you think about the last couple of years. So, and for most of the players in our industry, technology is not a competitive advantage. So there's really something to do. What I would love to do to invite you to talk to us on all those topics. And I brought just 3 topics to briefly touch on, which are important for us and which is something, especially in my role, looking at fintech partnerships, looking at innovation strategies for us here in Europe, which we are really focusing on. Number one is the whole thing around artificial intelligence. So when you think about asset management is making investment decisions, a better informed decision is just key for us to deliver a better outcome for our clients. So, and that can be on the one hand, market data. So sourcing market data, reacting on market data, interpreting market data. On the other hand, it can be around client data. So do we know exactly who is our client, how the client behaves, how the mindset is changing? So, and can we integrate that into our product? And the answer is so. I think we are comparably good on the market side. So of course we do NLP, we read social media on every single stock we invest in, but we are also still believing in the individual analyst talking to a company, understanding their business model, and really trying to force them into one or the other direction. But the client data element is one which we would highly invite you to talk to us. And I've heard that you probably already have seen or will see a colleague from Finanzguru, which I think is a perfect example of gathering client data, and to connect those set of data to the asset management industry would be key and relevant for us. The second thing, which goes into the same direction, is access to client. So our industry is normally intermediated. So that means we don't talk to the end investor. So there is an insurance company, there is a bank, there's a pension scheme, or somebody else in between who is a professional investor and who then holds the end investor relationship. Will that change? Probably. So Fidelity is one of only a few companies in the asset management space that has already launched a direct end investor business. So where we deal with the end investor, where we provide our products directly to the end investor. So is that something that will continue? Probably. Is that something we will do ourselves? Of course, we do parts of it ourselves, but we are looking for partners to really find intelligent ways, smart ways to deal with the client. And that's not robo-advice, to be very honest. So we have looked at robo-advice, and we think robo-advice somehow, at least here in continental Europe, has failed to really come at scale. And again, when you think about the 25 trillion in assets, and the last number I've seen on robo-advice is just shy of 10 billion, I think it's still nowhere. So the last thing is around infrastructure, and that's more a midterm topic for us. We are, of course, on the path to optimize our infrastructure, to optimize our data handling, and we're quite good in that. And I would say the industry as such is quite good in that. But there are always services in that which could help us. Think about regulatory reporting. Think about model portfolio services. So think about index creation. So think about all those elements where a traditional infrastructure is okay, but can do much better, and then there's even more room to grow for us. And then there's the next step, which is around DLT blockchain. So how does that type of technology or that philosophy will change our industry? When you think about that, we deal with assets, we deal with stocks, bonds, we have highly complex settlement infrastructures there. So we deal with legal wrappers, highly regulated. Of course, there's a strong belief that at one point in time, blockchain, the technology, the idea could change our industry, could change our infrastructure massively. So there's not a single asset manager, at least under the relevant ones, so who has not launched activities in that space, trying to understand what's going on, trying to understand so how clients react to that and how that infrastructure might change or might help us with the business we're doing. And of course, I think look at cryptocurrencies. So one of the big questions in our industry is if cryptocurrencies are a reasonable asset class to invest in. So, and I think the movements of Bitcoin putting some question marks behind, but there is a very strong belief on our end that of course cryptocurrencies will find their way. Will find their way in portfolios, will find their way in investments, will find their way in indices. So how to deal with that? We'll see. We'll find a way. Fidelity was pretty early in that space, so we launched our crypto activities in 2014 and are well advanced in that space, but there is so much more to learn. And of course, when you think about, as I said, traditional assets can be and will be tokenized. And with the experience of passive, I've talked about earlier on, so where everything that can be ETF'd will be ETF'd, and probably what can be tokenized will be tokenized. So just think about the technology and think about the way we deal with that. In summary, asset management can and will be a thankful partner to you. So let's have a chat. Let's dig deep into that. Let's find out if the model you're representing, the model you're thinking about, so works with our model. I will be very honest saying that finding the right model is not a challenging element of my role. So my role normally has even more challenges in implementing that and making it part of our existing business model. But we will make that. We will find a way to deal with that. And I think we are at a good starting point. You have a good industry here, and come and talk to us. We are more than open to that. With that, a very big thank you, and Felix, back to you.
All right, thank you very much, Christian. I liked one of your sentences. There's so much more to learn, and that's what we're telling all our audience as well. And if they want to connect with you, how will they connect? LinkedIn or?
Sure, LinkedIn is the easiest way. So please directly connect with me on LinkedIn.
All right, thank you very much, Christian. Thank you for your time, and hope to see you soon again.
With pleasure. Thank you very much. Bye-bye.
All right, so next up, new technologies bring new challenges. And here are the latest trends on corporate banking. And let's see how the future of good corporate banking is shifting right now.
2020 was a complicated year for corporate banking. It went from being the growth engine of wholesale banking to being in the front line of the crisis. Provisions spiked to the highest levels in a decade. Net interest income collapsed as central banks cut policy rates to near zero or even negative, and banks had to manage the extraordinary demand from corporate and SMEs for emergency credit, often via government schemes. While banks have done well to support their clients through the crisis, which should pay dividends in the future, the economic impact on corporate banking has been real. During the next 5 years, we will probably see a normalization of risk costs due to a cyclical economic reversal. Banks will also face regulatory requirements to set aside more capital and comply with strict liquidity and funding rules. A decade ago, location was the key factor that determined the companies that led the market and the companies that were left behind. Today, successful corporate banks distinguish themselves through superior cross-selling capabilities, loan pricing skills, and cost efficiency. These areas offer banks tangible opportunities to improve their performance. What are the main challenges for corporate banking right now?
The banks are in general inquiring regularly their customers and receive feedback. And here I think there is a huge difference, a total switch between the answers 5 years ago and today. 5 years ago, I remember the answers were more like, I want a tailor-made solution adapted to my needs. And this was translated behind into complex structures, quite difficult to implement. Now it's like, I want simple tools, I want a standardized product, I want you to be quick, I want you to guarantee the security of my transaction, and I want a flawless execution. On the other side, banks are challenged in terms of profitability. In a period of economic downturn, revenues are quite uncertain, cost of risk might be also high. So the only solution is to make your business model as a bank more efficient. And how you can do this? By automation, digitalization, and innovation.
Within the corporate banking landscape, there are also younger players who are witnessing how complex this environment can be.
So I hear time and time again from our clients, it's all about working capital visibility. So how much money is in my banks? How much cash do I have? And I mean, this has always been one of the key focus areas for any treasurer, and the COVID situation, the COVID crisis has only further revealed the critical importance of it. And it's not just about getting cash visibility, it's about getting real-time cash visibility, meaning what is in my bank account now. And I still see clients fussing around with their e-banking tokens now in their bedrooms, working from home, trying to approve multi-million-dollar payments. And yeah, I mean, for a lot of companies, this real-time, getting this visibility over cash has led to the failure of a lot of companies or the survival. And boardrooms are now shifted from EBIT to cash.
Corporate banks need to offer a distinctive value proposition if they want to retain market share, broaden revenue pools, and avoid disintermediation. In order to do so, they must draw on their expertise, data, and strong relationships. McKinsey has identified 4 potentially transformational levers for corporate banks. The first one involves strengthening your relationship with customers by offering them a diversified and multi-channel experience. The second is an end-to-end digitization of processes. The third involves reinterpreting the products that you offer. Finally, the fourth, which talks about engaging in an advanced analytics experience.
Because there are other trends in respect of collecting data, not only from my data, but also the data from the market, like maybe energy consumption, for example, or something like that, which will also help me to understand better my customer.
Just about bringing the data in, you want to make use of that data. We have very powerful analytics, which allow you to drill into your cash through different dimensions, flexibility over charts, so viewing cash across regions, business areas, currencies, banks, countries, accounts, reconciliation, so bringing real-time faster. The corporate customer isn't chasing their bank, they're not coming to the bank anymore. It's if you want to keep your customers and your corporate customers, the banks, financial institutions need to go to the customer. And it's the trend which we spoke about earlier. It's about becoming more embedded in the client's existing workstation and work environment. And I mean, the ERP is a great place to do this.
Corporate banks must put in action a plan to leave behind their legacy systems and deploy new technologies. These new platforms have to be modular and cloud-based. They must support end-to-end digital journeys, lower operational costs, and enable a superior customer experience. This means a huge effort for corporate banks, but the goal is worth it. By updating their technologies, they should be able to reach a cost base that is structurally lower and variable.
The biggest challenges, I would say, in the corporate market, is to make the fitting of your products with the corporate legacy infrastructure. How to actually adopt your products and how to fit your products with the way customers prefer to see your product be presented in the digital channel. So these are the cases about banking activity and digitizing of your products and delivering of any kind of your products, no matter what we are talking about, whether these are derivatives, whether these are instant payments or trade finance.
Banks should think of the technology as a way to focus on the customers, to boost their trust and to manage the flow of capital. I think they should follow the example of the leaders in digital transformation from other industries and use the data to sustain the best technologies that serves those purposes, like artificial intelligence, automation, cloud, and everything. So therefore, providing additional digital features is becoming increasingly essential. And this is also valid for more complex customers like the corporate ones.
Disruptive technologies are having a profound impact on clients and their relationships with their banking counterparties. We're talking about technologies such as distributed ledger, artificial intelligence, big data analytics, cloud computing, or APIs.
API is obviously a buzzword and it's hit the corporate banking space now. It does offer real-time data, real-time working capital visibility, instant payments, and I see more and more APIs coming up. So a lot of banks have yet to start their API journeys, and a lot of banks and some other banks we work with are very advanced. We see this trend continuing, more banks moving towards APIs, more types of APIs and new data offerings, maybe in the bank account management space, status handling space. And then this continual removal of third-party systems. So with APIs being allowed to embed directly in the corporate's existing workstation, you now don't need all these third-party systems and these third-party layers. So I see a disappearance of these layers.
Clients have shifted their preferences from speed to instantaneity in service execution. But is it possible to really offer your services in real time?
I mean, you hear this for years, real time, but it's such an abused term in the industry. Nothing is really real time when you have interfaces from one system to another and separate logons and access, and you're putting lots of components and layers in the way. So yeah, there's always going to be complicated interfaces, huge implementation projects to implement to interface these systems, and then the result is unreliable data output or even duplication of data.
Financial institutions are digitizing most of their services, and they're applying all kinds of technology to do that. An example is the development of predictive financial models through artificial intelligence. AI enables more sophisticated and automated analytics tools, which can improve accuracy rates and create more robust models by effectively crunching data. A better handle on data enables banks to better price their products while making it easier for corporate customers to buy them. Artificial intelligence is also used by banks for real-time screening capabilities and faster payments infrastructure. AI-driven banking solutions optimize companies' cash flows to ensure SME suppliers are paid on time. This is an ideal outcome that reduces risks for both buyer and seller. Some banks have started using machine learning and analytics to better understand customer behavior and digitize its processes accordingly, including streamlining the loan application process for SME clients. There are many case studies and examples of this digitization. But one of the best examples is how customers are now demanding an always-on access to data.
Finlink apps are designed to meet the generation today, which is always on demanding, always on data. And I think the best example of this is the bank statement. As a consumer today, we don't wait for our bank statement to arrive in our post. I don't rely on the bank statement now in the mail anymore, or even as a PDF to tell me these transactions. And it's very much in the corporate banking space. This is the shift. And why rely on a bank statement when I can get real-time visibility? The transactions are happening in a 24/7 world. Real-time payments happen any time of day. And why not leverage that visibility in real time? Why not take advantage of that working capital?
Historically, balance sheet strength and creditworthiness were among the primary considerations for clients when selecting bank counterparties. Nowadays, cybersecurity has gone up in the ranking. This problem impacts banks 24 hours a day, and it is one of the most serious risks that financial markets are facing. Most financial institutions have deployed significant resources as a preventative measure. The volume and intensity of cyber attacks have increased over the last few years, and it is something banks need to be fully prepared for.
In the industry, there's a few different security methodologies to secure the data which moves between the corporate secure network and the bank. the more layers that you take out, the more secure the process. The more interfaces, the more components, the more times you're going to create some type of file, secure it one way, and move it again, secure it another way. It's just a risk. All of these things are risks. As soon as you put one layer in there, you've created a risk where somebody can manipulate. Now, with APIs, they're leveraging latest security methodologies. So the banks create this API. It allows you then to synchronously embed that API in the existing workflow. So now there's no layers. So now there's just point-to-point connection and secure. However, the banks have taken different types of security. So there's ways where you can secure the channel itself. So an SSL certificate is a way to secure, encrypt that channel of data. OAuth certificates, tokens, are another way to secure that channel. And then even if you could then take it even one step further, you can apply an encryption layer to the payload, the data within the channel itself. And some banks will say, yeah, we also require corporate customers to provide that extra layer of security and encrypt not only the channel itself, which is secure and encrypted, but the data which moves within the channel as well, which is the payload. So yeah, you could apply an SSL certificate security to that particular payload, or even a PGP encryption, for example.
In order to fast-track their innovation strategy, banks are starting to partner more and more with fintech startups. While many technology startups are very good at identifying specific problems in the value chain, they often lack the wider infrastructure, resources, and client base to accumulate market share. Through these collaborative partnerships, agile fintech providers can leverage the resources and industry experience at major banks and enable them to scale more quickly and deliver solutions to a wider audience.
We are working together with financial institutions in a way that after they are fully onboarded, they receive a login to the platform and notifications once new projects are uploaded. These institutions gain access to pre-filtered deal flow that lowers the internal burden of analyzing a deal. Especially in times of COVID-19 and travel restrictions, this is a great value proposition as own marketing abilities are limited. Furthermore, they can invest capital in the maritime industry with a very small team and associated costs.
There are banks facing increasing competition from the fintech and all these disruptive technologies which are able to adapt quicker and to be more agile due to the lower size compared to a bank. Yeah? And this new trend, the emergence of the fintech, is completely changing the competitive landscape and are forcing traditional financial institutions to rethink the way they do business. And all these challenges can be resolved actually by the very technology that caused the disruption. But here the transition from the legacy system to the innovative solution hasn't always been an easy one. Yeah? So the conclusion, the banks need to embrace the digital transformation if they wish to survive and to progress in the current landscape.
I think one of the most important things in the next years is the cooperation between banks, corporates, and also third parties like fintechs on the market. That means that you have to consolidate all the services from these players together in a digital way and bring them on a table and discuss solutions which are valuable for all the parties which are involved.
So we also in Raiffeisen acknowledged these trends and we have adapted also, and we are developing several solutions and working closely with the fintechs this year in the Elevator Lab program, which was defined especially for corporate and legal entities segment. We have developed this year program looking for solution in the data analytics and loyalty solutions for companies. So the conclusion is that we understood that the data is the new currency, and partnering with a fintech can help us as a bank to adopt more of the agility of a startup.
Cash management has played an important role in the corporate banking territory during the last years. A successful cash management business is not only based on past achievements, It is based on the ability to invest in innovation that will allow customers to tackle the challenges that lie ahead. Without technology, cash management companies would not be able to face the new landscape. Innovation allows them to reduce operational risk, manage regulatory requirements, or tackle growing cybersecurity risks. Investment in these areas grow every day. Banking and financial institutions want innovative solutions, and they want to be able to anticipate customers' needs. And they do so through standardization, real-time reporting, ERP integration, reconciliation, and an end-to-end view of the payments and cash management value chain. Financial institutions need to anticipate their customers' needs and manage channels of collections, payments, and accounting information to increase revenue and profitability.
So then what areas outside? So next is the status handling. So being able to track your payment. So in the industry, you have SWIFT and who work between bank to bank, and they have an initiative GPI, which allows full transparency over payment. So being able to now offer that to the corporate is huge value. So now corporates can have a status app and be able to track payments through, it's like tracking through a package. They can track the payment through cross-border banks, the bank fees, all the way to credit of the beneficiary. Then you have the whole bank account management space, which is again really interesting. So a lot of treasurers today keep their signatories, who are the account signers, in Excel, or they have to log on to e-banking. You know, if you've got 30 different bank partners and you've got signatories, all different directors all over the place, to keep those, and the knowledge of that in e-banking is a huge challenge. So now APIs allow you to unlock this data from the banks and bring this directly into one place inside the ERP system, and you can see all these account structures in a very nice, intuitive chart.
Corporate banks are encountering complex and dynamic challenges. In order to face them, they need many things: organizational agility, an aspirational vision, investment in talent, a multi-year roadmap and budget, and an IT architecture thought to generate value for customers. Corporate banking has traditionally been considered more of an art than a science. However, current challenges demand management rigor and a technological expertise. The corporate bank of the future will be more responsive and ready to compete. Getting there, however, will require work. Banks will need to reimagine their front, middle, and back offices and develop leadership skills in innovation, risk management, and service.
As corporate banks engage in efforts to transform for the future, they will face complex dynamics. The panel Building the Corporate Bank of the Future, Now or Never, will revolve around how corporate banks must embrace the future and engage in transformation in order to remain competitive. Now let's zoom into the panel and introduce the moderator of the panel. She's financial reporter at the Wall Street Journal. Hi, Patricia Kausman.
Thanks, Felix, and hi, everyone. I hope everyone is doing well and enjoying the conference. These are strange times, and it's strange to moderate a panel without an audience. But nonetheless, it's great to be here and to see you all virtually, and I hope you find the session productive. My name is Patricia Kausman. I'm a correspondent for the Wall Street Journal, and I cover banks and finance in Europe. And this panel will talk about corporate banking, how it's been traditionally done, what's changing, and what its future. I think this topic is particularly fitting right now because companies are facing challenging times under COVID. And in many cases, their finances have been disrupted or the business models have been thrown out of the window. As you know, corporate bank is an essential part of how economies move. It's essential for companies to fund their operations, to manage the cash, and to hedge against risks, and obviously to grow. And corporate banks help companies with all that. Traditionally, these are big banks that we all know very well. They also do kind of service for retail clients, but there are other and new kids on the block. So let me introduce you to the panelists. There's Caroline Oostenbaan. She is an executive committee member of NIBC, a Dutch bank servicing small firms and retail clients in Northwestern Europe. And she's the head of corporate clients in the growth and innovation sectors. The business provides fintech and technology companies with finance and advisory. Next is Miriam Wolfart. She is the founder and managing director of RatePay, a Berlin-based fintech founded in 2009. It offers online payment solutions that allow shoppers to pay for invoices, installments, or direct debt, instead of with credit cards, which people in Germany, Austria, and Switzerland are actually less fond of. Some 3 billion euros were transacted through RatePay in 2019. Miriam also recently founded another fintech called Banksware, which provides embedded financial service software that allows digital platforms like marketplaces, payment providers, and other aggregators to offer financial products like loans to the merchants. And then we have Thomas Schnarr. He's a partner and head of Oliver Wyman's financial service practice in Germany and Austria. He helps financial service clients define their strategies, including when it comes to their corporate businesses. So let's start with, a big question, which is what's the future of corporate banking? I mean, ultimately, that's what we are planning to help answer right now. We're hearing from the experts on that. And I think in order to answer that, we need to take a step back and ask, is there an actual problem with traditional corporate banking? And what is the problem? What is great about this panel is that each panelist here can provide a different perspective. Thomas knows the traditional banks very well. Caroline works at a specialized corporate banking provider. And Miriam comes from the world of fintechs, which we can call the new disruptors. So I think to answer the question, is there a problem with traditional corporate banking? We should look at the issue from a corporate perspective or a customer perspective. Miriam, I'll start with you, given fintechs are providing new solutions to banking and finance. So it'd be very interesting, I think, for us to understand, have companies as customers changed? And how do you think that affects their needs in terms of banking? In other words, basically, why do you exist? Why did the fintech start popping up?
I think actually there's not such a big difference between private and corporate, because actually the person that is dealing with the stuff is a person. And this person is a human being that is used to things like Amazon now since more than 20 years, Netflix, Apple, apps, and all this. And what happened actually in the last 20 years is that the people have a different demand when it comes to easy things, fast things, and convenience. And let's see, if we go back to the banking then, if you ask the question, why is corporate banking not like this, or why it's difficult, it's probably since it's not really that easy and it's not so intuitive. So I think what the consumer really wants is a super easy solution like Netflix, whatever. And this is why in the last years, actually, you've seen a lot of rise of the neobanks in the more private sector, like Revolut, like N26 or so. And I think they rose because of convenience, and actually they really addressed a customer need. They saw that people like to, let's say, do it in an app. They like to let's say, do the banking stuff differently. And this is going to happen now in the corporate sector as well, because actually the people that are using the private banking tools, these are also the ones that are in the companies doing the corporate banking, and they expect from the corporate banking a kind of, let's say, thing that is similar to the Amazon, let's say, gold standard.
Mm-hmm, mm-hmm. I mean, you say this and we think about the traditional banks, right? And traditional banks are not Netflix, they're not Amazon. And one can say they're struggling with the concept or even the idea of transforming themselves. Thomas, I mean, where do they fit in, the traditional banks, which are still like the chunk of the providers of corporate banking, right, to customers? And are these traditional models working really?
Yeah, thanks, Patricia, and thanks Plug and Play also for having us here. So I would start by saying that corporate banking has always had a bit of a reputation of being a stable and a slow changing business within banks. And I can actually attest to this firsthand. So many of the projects that we're doing now and that we're helping clients do focus on very similar topics to the projects which I did 20 years ago when I started out with consulting. And I think this stability, of course, brings a lot of benefits to the banks, but it also bears a risk, which is when you are so stable, you don't really exercise your change muscles, right? And so corporate and transaction banks in particular haven't been through a period of rapid change. And I think this is why they are feeling so challenged and pressured at the moment, and are struggling to really maintain the relevance with the client. And I want to give two examples which illustrate of what is happening in that space now. And then I'll start with the world of trading currencies, where a lot of new FX trading platforms have emerged, and then they enable price comparison. They allow corporates to net the flows of currencies which they trade with the market, and they allow corporates to really choose whom they're trading with. And all of these are aspects of convenience, as Marion was saying before, which have led to a huge margin compression and have completely changed the entire market landscape when it comes to trading currencies. And the second area I would mention is transaction banking, which is where trade finance, cash management, payments happen, and where we have seen that the landscape has changed into something where a lot of very specialized services are being provided, either to a certain type of corporate or around a specific service. And this is very different from the monolithic culture of banks, which have used to offer like one thing to everyone. And if you add to these two trends, then the fact that in many of the corporate and transaction banking products, profitability has gone down, also as a result of regulation, but also as a result of low interest rate, then you see that actually the traditional model of corporate and transaction banking is under a lot of pressure for the traditional providers.
Mm-hmm, mm-hmm. And I mean, the Carolina is going to be interesting because she does both. She works in a corporate bank, but she also services fintech, and probably a lot of the players that kind of are coming in to kind of disrupt this sector. Carolina, like unlike corporate banks that tend to serve all types of customers, your bank actually is focused on specific sectors and countries in Europe. It's a bank that's been around for decades, 75 years, if I'm correct. So I assume it has had to adapt. So it'd be really interesting to hear from your experience, what is the challenging that you guys have faced, particularly now with the disruption, technology, and customer, perhaps changing a bit the way they see banking as well.
Yes, thank you, Patricia. It's great to be here. So thank you also for the invitation. Well, first of all, let's maybe start by saying that I see challenges, but definitely also opportunities for the incumbent corporate banks. And maybe I'm also lucky because besides financing advisory, we also do equity and mezzanine. So that also means that I'm responsible for our minority equity investments and also investments, 100% investments in fintechs. And we have also a number of investments in fintechs. So for me, I really feel we have the best of both worlds. If you look at the challenges from that perspective, I'm not sure it's very different from other sectors or industries. It is so important to adapt yourself to the environment and to the situations you're faced with, whatever sector you are in. And I think incumbents, sometimes you could say, okay, there are two things. One, you don't have the newest technology. And in most banks, specifically very large banks, that is quite that's a huge conglomerate of systems, which are legacy. And the other thing is, of course, that you have a lot of people who have worked in a sector for a long time. Well, sometimes people say legacy minds and legacy systems. Right? So there are two things that you have to deal with. And of course, Thomas also mentioned you have the regulatory pressure, which is definitely a lot heavier than it was. And you also have the question of focus. You see that many fintechs are really focused on one or two products, but basically usually one product. It's culture and mindset, it's systems and technology, it's focus, and its regulatory environment. And of course, if you then add the macroeconomic environment with a low interest period, and also a turn of the cycle, which we are seeing at this point in time, there's quite a lot going on. But many players, and including ourselves, a couple of years ago, we already, of course, saw quite a lot of these things coming and happening. And we have worked very hard with our people to really embrace change and working with fintechs, both our clients on the financing side, but definitely also our fintechs in which we have invested, either minority stakes or 100% stakes, have really helped us open our eyes, broaden our horizons, and see what is possible. So then at least you have a culture and a mindset of really trying to help your clients forward using either new technology or a faster, more efficient process, or whatever is possible. And I think what is really important is focus. I think that the future of corporate banking, you will have to choose more than you do now. So we have really asked ourselves questions: what are we famous for? What can we be famous for? And focus on that. And so we have indeed focused on financing, specific types of financing for specific asset classes. We don't do payments, for example. We don't do Forex or that type of business. So we don't do a lot of things. We stopped our markets business last year. So a strong focus is definitely required. And then, for example, to give you an example, Patricia, we were looking at client portals. So we really wanted to have client portals. Well, that is quite a step in our technology transformation. But one of our fintechs is offering it. So we are looking now to offer that capability to our clients with the help of one of our fintechs. So I think combining the incumbent plus fintech is really the answer.
Yeah, I'm feeling the urge of like
long answer, but it's not going on.
No, it's great. And I feel the urge to jump into the last question, which is, so what is the future of corporate banking? Because, you know, one way of thinking about this, and one question that I have, I cover traditional banks. So, you know, traditional banks have big balance sheets, right? In other words, they have a lot of deposits, a lot of money where they can't use and lend and do things in a completer way, or that is at least their claim. The banks can do a full service to customers that they claim fintechs cannot. Fintechs are sort of, like you said, niche. They do one thing usually, and they do that one thing clearly pretty well, but it's harder to fulfill the whole, to make the whole package in order for banks to actually be replaced by fintechs. They would have to be replaced by a bunch of fintechs at once, which is, you know, and so you hear a lot of the banks saying, traditional banks saying, well, we see, while before we saw the threat of the fintechs as existential, we now feel like we are going to absorb fintechs. The smart banks are going to be able to have the fintechs providing services to them, but they still will be the banks that exist today. I don't know if you guys would agree with that assessment. And again, I'm jumping into the last one, but we might as well get to the heart of the question here, which is, what is the future? I mean, can fintech take over banks? Would they coexist? What is corporate banking is gonna look like 10 years from now?
I would assume that there is kind of a coexistence. So if we look at really, you know, software eats the world. I think I really like this phrase because it really stands for something. And I think those companies that are best in software, best in technology, are the ones that will succeed in the future. And these can be banks and these can be fintechs. So I would not say there won't be any banks and there won't be any more fintechs. But it depends if you look at what is fintech. Fintech is a kind of, let's say, unbundling of banking services. So let's say there's always this one thing a fintech does really well, and maybe you have a bank that is really I would say super smart in combining their own technology with the ones of fintech. I would probably think that these are the ones that will succeed, because then you have the best of both worlds. And at the end, it's really about who has the best product for the customers, and the customer is the one that is really choosing hard. And if you have good technology and you know your customer, then the customer will come to you. And I would really say that probably it is like this, that there is kind of like a platform banking, which is the future. There is a bank that has an infrastructure in a way, and the bank itself does some services, but it will need additional services from fintechs in order to, let's say, make the customer happy.
Mm-hmm. I mean, would each bank have a like sort of menu of fintechs where you can, as a customer, use, or would there be like collaboration with banks in specific fintechs where one fintech is going to provide the service for the bank?
Yeah, I think it actually would be the best thing if it kind of, let's say, the bank has an open API, and then you can have, let's say, for different products, you can choose actually different kind of services. And this can be a fintech service, or this can be an own banking service. And maybe have even several fintechs, but this maybe doesn't make so much sense. I mean, it's also not so easy to integrate so many different ones, but it makes sense if you are a bank and you have a kind of platform and you offer all the services along the, let's say, an end-to-end service. And some of the end-to-end services is done by fintechs. This could be something. This could be a possible scenario, what I think. Or on the other hand, what also could be that one of the big, let's say, platform players, like a Google or whatever, that they actually, it's also, I mean, we at Banksware, for example, we do embedded financial services. So we empower every platform to be, let's say, to do banking services. So I could also think about, let's say, big platforms in the future becoming banks by themselves with the power of banking. So, but it's not really this one place that you go to. It's more or less probably going to be a kind of, let's say, digital financial home that everybody wants, where you get all the services.
Yeah. I mean, it's a good point that you make that, I also remember banks, first of all, they got freaked out by the fintech, thinking fintechs are going to take over the world. And then they are like, okay, I think we can deal with the fintechs, or we can work with the fintechs versus against the fintechs. But then the real trouble, which I heard from a lot of bank executives, is at the actual Googles and Amazons, like these big animals that actually can do banking. They can become direct competitors. I mean, Thomas, what's your, if you can give us a bit of a flavor of what these big corporate banks are thinking and how they're facing this challenging, I think it'll be really interesting.
Yeah. So my personal view is I agree corporate and transaction banking, and I always name the two together because I wonder actually whether in 5 to 10 years time we will still be talking about corporate and transaction banking, or whether we'll be talking about corporate and transaction financial services. Because similar to Miriam and also to what Caroline said, I think that the future is going to be much more agnostic as to like who the provider is. So look, for example, at the payment industry, which Miriam knows, of course, very well. But there we see a move where payment services are being carved out of banks. They're being lumped together, particularly here in Europe. That's certainly the case. You look at other products such as let's take lending, which still is very predominantly in the hand of banks. Of course, there are crowdsourcing services, but up to now that hasn't really taken off. You look at capital market services, which again are in most cases still firmly in the hand of banks. So I think it's going to be a very different story depending on which product we are talking about, which client segment we are talking about, which market we are talking about, right? So what is going to happen in Europe is going to look probably very different to what is happening in the US. And so I guess the key skill you have to learn is, as Miriam also said, and how can you get close to the client, and how can you ensure that the client is getting the best service, right? And if the client feels that you can advise them, that you can coach them, that you can potentially insource other services from others, be it via platforms, then they will come to you for advice, because the world is out there is getting more complex, right? So if I'm a corporate, everything is becoming very confusing. Beforehand, you were going to one bank and they could, at least they claimed they could provide everything, right? Now you have tons of fintechs or maybe a Google offering to look at. And so even the service of advising a client will, I think, become more valuable. I also agree that the big ecosystem players like the Googles and the Amazons, they have probably been a bit overlooked when it comes to financial services, and I think it's not yet clear which role they're going to play. And equally, I think we shouldn't underestimate particularly the US banks, which in size are now playing in a very different league to most of the other banks on the planet, with the exception of the Chinese, of course, right? And I think investment money and investment power is going to be a differentiator here. So I would also assume that we will see those succeeding who are able to either cleverly combine different offers or invest for themselves.
Yeah. Caroline, what's your take? I mean, you went through it in your previous answer, which was really good. But if you think about your bank and in the way it deals with the fintechs, what do you think is? And you mentioned some of it already, but what do you think it's going to look like? I mean, even the way you do banking now, when you, I mean, have customers even changed the way their demands? I mean, do they come to you and say, I kind of want an easier solution to do X and Y. Can you provide this to me? Have they changed themselves in a way that's forcing corporate banking to change?
No, I agree actually with a lot of that has already been said. So what Miriam said and Thomas said, looking at the future, I mean, it's definitely not only fintechs I'm looking at. I'm also looking at indeed the big platforms, but also Thomas, I think, touched upon it, investment money. There are many funds, there is so much liquidity in the market. That of course has a big influence on the lending propositions. So it really will depend on the type of product, will depend on the size of the client. I mean, we also work from middle-sized companies, so small, medium, large. They also have different needs, different requirements. It will depend indeed on the region. In the end, I believe indeed that for each product, you have to have a really good proposition that really serves clients' needs. And the times have passed that you can work with a mediocre product in terms of client needs and expect that to survive. I think you really have to understand that there's competition from many sides, and rightly so. Of course, there should be some sort of level playing field, which is not always the case now, but there is competition. So that means that you really have to make sure that you offer the best you can. And I think that is a good thing. Maybe some banks have been a bit complacent, have believed that the world would always be like that, like it was. I know banking professional said, if you now finance a factory, how different will that be in 5 years' time? Well, it will be very different. So that's one thing that you should assume. Mm-hmm. And then, I believe in partnership models. I also believe in innovation, not waiting. So probably I would expect for us some sort of combination as we are doing now. But in any case, never be complacent. I think that's really important.
Yeah, and I mean we're in Europe, where the banking landscape is quite different from the US. Banks are struggling much more than the US banks. you also have fintechs or a fintech environment that may be very different from the US. It would be great to hear from you guys a bit about what the challenges are when you think about corporate banking in Europe versus the US. I don't know if anyone would have thoughts on that.
I think if you just compare the money that is taken for innovation in the US banks, if you compare that, for example, to the money that German banks use for innovation, it's a huge difference. I don't have the numbers in the head at the moment, but I have to look it up. But I saw like last year or so, and I was quite shocked when I saw what, for example, Deutsche Bank, Commerzbank are spending on innovation compared to like a Goldman Sachs or a JP Morgan. So this is something I think this has to change. So we have to make more investments into the future and into new technology, and we have to spend much more money on this. And this is a huge difference to the US.
I mean, Thomas, how do you deal with that? Because I mean, indeed, I mean, I don't know, but one of the justifications I assume one would give on why Europe is a bit behind on that, or a lot behind on that, is the fact that banks are struggling with everything else, right? Banks in Europe, banks in Germany make very little money, and one would assume part of the problem of not investing so much in technology or sort of trying to speed up the process is the fact that they're stuck with other problems, like legacy problems. I don't know if you agree with that.
Yeah, so I think even if you look into the US banks or the Asian banks, that they for sure also have a legacy. So I don't think that this is the fundamental key to the question. I'd rather, if I may, just take a step back, because I think there are some reasons in the market structure which make a big difference. So the first one I would mention is that the European market is much more fragmented than the US market. So if you want to be a truly European bank, you have to master a number of languages, in some cases even currencies, legal environment, etc. Whereas in the US you have one big market, right, which makes things just naturally a lot easier. The second factor I would say is that if you look at the profitability in the wholesale space, it's clear that the US is much more profitable than the Europe, which points to a sum of imbalance or different balance between supply and demand. Meaning, I think that European corporates in general are overbanked, right? And there is much more competition in Europe than there is in the US. And as a consequence of simply these two trends, I mean, look at the simple size of US banks versus European banks, right? There is a stark difference, which then also has a huge correlation, of course, with the opportunity to invest. And there are many factors playing into that, such as also the role of the US dollar, the clearing capacity, the depth of the capital markets, etc. But in essence, I mean, what we have seen over the past 12 years is that US banks have taken away market share from European banks, both in the US and in Europe. And as such, I think that there is just a very stark difference. And then the one thing which is in the hands of the banks and that of the financial system is that over the past crisis, the US banks typically have been much quicker in cleaning up the balance sheet and leaving the crisis, right? So whereas European banks have tended to have more problems on the balance sheet, which drag on profitability and which therefore add to the problems, and Patricia, which you were alluding to. And as such, I think it's a pretty structural discussion that we're having, which and maybe the Capital Market Union initiative by the European Union is one way out of it. But we must be conscious that I think here we are really still in the first innings of a very long game, because until we reach the situation where we have a harmonized legal framework, harmonized workout situations in Europe, that's going to be some time off. So my personal view is, unless there is a huge push on consolidation, it will be very hard for European banks to rival US banks in investment money, which in turn means I think European banks will need to craft their own way, a different way. And then that could be cooperation, could be one of focus, which Caroline mentioned. I think that's a very, very important element, or could be one where you just do a very specific thing for a specific client segment. But I think European banks it will be very hard for them to outspend the US ones.
No, I completely agree. Yeah. Patricia, we have hardly any time left, but I think this point of fragmentation that Thomas mentioned is true for corporate banks, but I also see that for fintechs. I mean, it's the same for all players who would like to consolidate across Europe. They are faced with different languages, different regulatory regimes, different workouts. Well, I mean, name it. It is scaling in Europe is much more complicated than, of course, in one system like the US. And then, of course, specifically also the German market is a very competitive market with many financial institutions. So consolidation will have to take place. So it's but also don't forget that profitability is also for fintechs often a problem. And also now in COVID times, you know, that continuous push on fundraising that does take up a lot of management time. So incumbents, fintechs, we all have our issues, but also our great opportunities. Let's also say that.
I mean, I had more questions, and I'm sure you guys had more to say, but it seems like our time is running out. One last question, I think, because I think we want to mention COVID, right? COVID is changing so much of the world. Miriam, it would be maybe good to hear from you about what do you think COVID has done, what COVID has done to the banking landscape? I mean, if you think your own fintech does, you know, payment, it sort of facilitates online payment, which has become like, if something has like really increased over the past year, it's been online payment. What do you think COVID has done, or do you think COVID has actually done anything in this, you know, sector that we should be pay attention?
Yeah, I mean, COVID has changed behavior. Yeah, if you look at it, it has been a main behavior changer, especially in payments. People, especially in Germany, which was not a card-based country, people now pay with card, they pay mobile. So this has changed behavior. But also since people stayed at home, they did a lot of their banking stuff at home, and they started using much more apps. They started using trading apps, and I think it has. Fintech has gotten a push through COVID. I mean, yes, some things have become more difficult, the ones that were in the point of sale, like, you know, but I would say if we look at the industry itself, it has gotten a push through COVID because the people got more digital. And so this has the changed behavior. I think it will also stay. I mean, what has been difficult, I think, through COVID is the funding rounds, the funding for startups. Because I'm also quite involved in the startup scene here, more in Germany, not so much international. But I can see that it's more difficult for very young startups now to get funding because it's the times, it's not so easy. The ones that had already, let's say, that had been in business quite well, they received big funding rounds, but for the new ones, it was not so easy. But at the end, I think, yes, I think Corona is, for the fintech industry, or probably also for the whole tech industry, it is a push. It is a big push. That's my personal opinion. And for RatePay, I can also see it. I mean, we had, even through Corona, we had 30% growth this year. So, and even if we had customers like airlines and bus transportation, so there were some customers that were really doing bad, but most of the customers, they have been doing so great, so that it's still at the end, we had a really good year.
Yeah, absolutely. Okay, I think that's the time we have. I wish we could speak for much longer, but there are other things that need to happen at the conference. Thank you so much, guys, for this. It's been really helpful. I hope the audience finds it helpful as well. And we see you next time, and everybody stay healthy, both here at the panel and the audience, and hope 2021 is a better year for everyone. Thank you.
Same to you.
Thank you very much. All the best. Bye-bye.
Thank you.
Bye.
It is becoming increasingly clear that diversity in the workplace absolutely matters. Diversity has become a competitive differentiator that shifts market share towards more diverse companies over time. The panel Diversity and Inclusion, Making Diversity a Reality, will focus on how businesses can create and adapt their diversity initiatives to increase innovation and improve their employee performance. Let me introduce you to the moderator of the panel, Innovation Manager at Fintech Europe Plug and Play, our colleague Hannah Remde.
Welcome to Fintech Expo. My name is Hannah Remde and I'm the Corporate Innovation Manager here at Plug and Play Fintech Europe. Today I'm joined by Kirsten Oppenländer from Deutsche Bank, Sigrid Dahlberg, Director of Global Corporate Communications at Delivery Hero, Till Klein, the founder of Vantec, and Nina Pütz, CEO at RatePay. Welcome all, and thank you so much for joining today's panel on diversity and inclusion. So to set the stage for the audience, leading businesses and growing startups are taking steps to increase diversity, equity, and inclusion. And the evidence for the value of diversity is growing. So research has found that firms with advanced D&I strategies are roughly 30% more likely to have executives who report high levels of loyalty, innovation, and performance. And so today I'm joined by 4 great panelists, and join us as we discuss how they are implementing and also tackling diversity within their organizations. I'm going to start off by asking you, Sigrid, if you could tell us a little bit about diversity at Delivery Hero and what forms of programs you provide to promote diversity and awareness throughout the organization.
Sure. First of all, thank you so much for inviting us to this panel, and I'm happy to be in such great company, also with speakers who are not perhaps representing HR organizations within their companies. And I think that just shows how much D&I is really something that is ingrained in many companies these days, not just as a side sub-team in HR division. That is also how we're thinking about D&I at Delivery Hero. It is not something that should just be reserved for one team. It is something that the entire organization needs to work with, which is why we have quite an extensive D&I program that is clustered around 3 different pillars. And they are increasing women in leadership, tech, and overall, because we have a deficit of female representatives within the company. It is about growing inclusive behavior. And the 3rd pillar is enhancing equitable structures and systems. And for us, that is sort of a triple approach so that we can influence not only behavior, influence how we treat each other within the company, but also influence the structures that needs to be in place in order to facilitate that. So it's not enough in our book to do D&I trainings, like unconscious bias, etc., even though they form a really crucial pillar. But it's also about looking at the processes, the structures that we have in place to ensure that we promote equity, we do equal promotions, and that we are driven by fairness. And that is something we look at extremely cautiously, and especially now when we're entering a new performance round in the winter cycle, this is such an important aspect of it. So the program is clustered around those 3 strategic thematics, but there's so many other different things that we do as well. Like we have event series that are aimed at educating our people about different forms of diversity, whether it's surface or deep. We call it Let's Talk About, because these conversations can sometimes be uncomfortable to have. And each of these event series are actually accompanied by what we call a learning nugget. And this learning nugget is for our employees, we call them our heroes, no pun intended, to educate themselves further and actually learn more. Because we see that when we open another door, when we open a door to something that people have not experienced before, perhaps firsthand, it can be a bit scary. But if we take people's hands and guide them through the process, when we have a story which plays into people's hearts, but then also follow up with learnings that play into people's minds, it's a really impactful combination. So in a nutshell, that's the structure of our program.
Great, thank you, Sigrid. So kind of touching on that, Kirsten, I'm wondering what kind of, if you could give us an insight on how a large and established organization such as Deutsche Bank manages to promote unified diversity efforts, also globally.
I think the global aspect is the first one that makes this a very interesting topic, because something that would fly in Germany will not fly, say, in the UK or in the US and vice versa. So from everything that we do, we have that approach that we have a global culture, a global value set, but that obviously everyone locally needs to adapt it to the local environment. I think what's important is, and that's why I prefer diversity and inclusion really over diversity only, it's this inclusiveness that invites everyone to be part of the story. And the way we started to interpret this is, obviously we all have a set of not only obviously the culture that we operate in, but also the regulation and the legalese that we need to apply. We have the management style that we as a management team actually adapt and how we lead by example. We have what the employees experience in their day-to-day work, and we have how others see us. So what the market thinks about us, what our clients see in us, and I mean, what the overall news situation around the firm is. And all of that jointly sort of creates the value set that we go by, and also creates that kind of inclusiveness. And I think Sigrid has mentioned a lot of the components that obviously you would expect and see. The one thing next to programs, trainings, etc., that we started quite some time back is networks. So for a lot of the individual diversity stakeholders, you would find individual networks and ally systems. So we base a lot on the voluntary work of our employees, who then actually promote actively topics that then again influence others and also make others feel more at ease.
Great. So, you know, speaking about these different programs that you have, Nina, maybe you can touch a little bit on, you know, what kind of targets does RatePay set for diversity? Do you set any targets? And also maybe, do you think that these targets should be iterative, or are they set in stone once you set the targets?
So we don't set deliberate targets in terms of diversity. But I mean, we are compared to Kirsten's and Sigrid's companies a lot smaller. So we are a Mittelständler, German medium-sized company with 270 employees. So therefore, you don't need to do it as programmatic as you would have to do it in big corporations. The interesting thing about RatePay is that we have in general, across the whole company, 2/3 men, 1/3 women. But when you look at senior leadership and especially the board, it's totally turned around. So in the management team, it's 2/3 women, only 1/3 men. And then the management itself is 100% women. That's also not diverse. That said, yeah, but we have, in our case, the diversity with regards to gender is we live it, yeah. It's not something where we need to take immediate action. And then when it comes to the other aspects of diversity, I mean, for example, we have people from 30 nations in our company, then you don't have to do it as programmatic. For us, it's more, we live diversity as an awareness program. So across the whole organization, we do things like unconscious bias trainings and so on to ensure that it's not only about gender, because this I find so boring, yeah, that's not what it is about diversity, but it goes a lot deeper. And also for my personal liking, coming from a big American corporation where I worked for 15 years, we have still way to go with regards to cultural diversity. So for my personal liking, find our company very German. Yeah, so we have 30 nations, but the biggest proportion of employees is still German. So I would like us to become much more international and have a more cultural richness even more there.
Okay, yeah, great. And maybe, so Till, maybe you can jump in on that. How does it look like at Vantic? What are you doing to instill the importance of diversity across the workforce? And would you say that your company is diverse? Do you think it could be doing better?
Sorry that I'm laughing, but yeah. First of all, probably we are the smallest organization, and we are kind of the least informal setup. So we don't have any formal setup. And I would say to some extent we are diverse, but on the other hand, there's a lot to do. And then you suddenly recognize from a gender perspective, from behavioral perspective, there's so many open questions we haven't addressed. And the interesting point is you get at some point or to some point where you think about, do I need to formalize it? Because we are still so small that we think, okay, this is not a problem. We are all very open. So we are, by nature, we are diverse. And then we suddenly we recognize, oh yeah, maybe here and there, there's something to do. And it really starts with very small things. It starts, so it's also diverse in terms of different nationalities. And do the Germans speak German with each other? This is the tiny things when it starts kind of, okay, if you want to respect diversity, it is very important that even two Germans next to the coffee machine speak in English so that others can listen to it and can just chip into the discussion. And these tiny things, and then you recognize them. Or you have an application process where suddenly you think about, do I need to think about gender? Yes, maybe I should. And so that's more for us a question, do we need to formalize it? Do we need to set that up? And do we need to start to address it? So that's kind of where we are. So I think it's quite interesting to see this kind of from, probably we are the smallest up to an organization like Deutsche Bank on a global scale, and how that could be addressed in a very different way, although the core questions are always the same.
Yeah, absolutely. So I want to bring it a little bit to the elephant in the room, COVID-19. We all know it, we've all heard of it. So I was wondering, maybe Nina, you can touch upon this. We hear a lot about when things go back to normal. So I was wondering, you know, in terms of what you are doing for diversity, how has COVID-19, has it impacted this at all? And what are you doing from home to engage with one another and to keep that conversation going?
Yeah, so I think what is key in times like this is that you need, no matter how big you are as a company, you need individual solutions for individual employees. So single parents, yeah, everyone who has parents at the moment, you need a different solution than for millennials who don't yet have a family. There are different problems for working at home that you need to take care of. And I think the key is that whenever you think about solutions or making it easier for your workforce to work from home, that you take the individualism into account. Yeah, so we have implemented different solutions for parents, for mothers. So we have, they have much more flexibility with regards to working hours, for example. And then, for example, our younger singles, so our workforce, is our average age is in the mid-30s, but we have people across all different age groups. So you need to account for really different situations and problems, and that's what we try to do. And then the question is, what is the new normal? So I think even after COVID, we will never return back to these normal office hours where everyone was in the office at least 4 days a week. So for us, we have said that we would like, after COVID, everyone to ideally be in the office 8 days per month. And then we have also already allowed everyone to work from mobile office anywhere in Germany for 2 weeks per month. So if you have, for example, your little apartment at the Baltic Sea, you're free to work there for 2 hours per month after COVID as well. Yeah, and then there are different, so I'm currently thinking we need to help our parents a little bit more, depending on how long this lockdown will continue. So we're currently thinking about solutions of whether we support with childcare or do something there, because parents are struggling a lot, and we somehow need to find a balance, for them, that everyone can balance their private needs and also be able to do the work as flexible as possible.
And for you, Kirsten, within Deutsche Bank, because of course it's a huge established organization, when COVID hit, of course there was a lot of chaos all across the world. And I'm wondering, was it difficult in the beginning to move the conversation also back to keeping it on diversity, or in the beginning it was probably just a lot of trying to figure out how will the normal work life look like now? And I'm curious to hear how difficult or challenging it was for you and for the team at Deutsche Bank to, maintain the diversity efforts and also, increase them.
I think basically, if you think about diversity, and I think this was sort of mentioned before, looking at the individual, COVID actually strengthened that to a point. Because what we keep saying is, if you imagine, a lot of our teams actually moved to 100% work from home within days, literally, which is something, had anyone told me that this time last year still, I wouldn't have believed it. Yeah, so, and what we keep saying is we were more distant, but we're closer. Because the one thing that is interesting, if you look at the developments, even though also within the countries, the political actions were different, the timings were different, we have all literally experienced very similar situations. Close family members, friends fell sick. We had to readjust our day-to-day literally within the span of a week. And I think everyone also has a different situation, and that listening to people, approaching people and understanding where they are made us much closer. Nina gave a lot of examples, in particular, obviously, on the parental situation. The area where we're really concerned is mental health right now, mental well-being. Because if you think about the millennials, we have quite a lot of young people who live in very small apartments all by themselves, who literally don't see anyone. Yeah, so once we got into a stable environment where we knew everyone could well work from home, connectivity was okay, productivity was okay, we started readjusting the way we worked. So I have a lot of virtual coffees now, and somehow also the people that I have virtual coffees with have sort of changed, because there is quite a lot of people out there where it's more important to actually talk to them, listen, ensure that they feel okay, also from a who should actually be the people who are coming to office more regularly versus others who simply, for whom it would be a struggle to come to office for different reasons, be it health reasons, homeschooling reasons, whatever. I think that changed the way we work. And like Nina said, we are reviewing what part of that we actually want to bring into a after COVID work situation, whatever that after COVID will actually be looking like.
So touching on something you said, so you brought up the millennials, and I'm wondering, are there any differences in generations when it comes to diversity and inclusion? So, you said there are many different groups of people, and Sigrid, maybe you can elaborate on do you think that generational gaps need to be addressed? Do older people expect more or different things from diversity and inclusion programs? And do you guys build some sort of profile? And how do you address these generational gaps?
Well, I guess it goes back a lot to what both Nina and Kirsten said, which is to the point of individualism or flexibility. I think it's super important when you talk about diversity and inclusion that we don't look at one solution fits all. That's sort of completely disregarding the entire point of diversity and inclusion. And I think a lot of people are operating in similar ways, irrespective of what age they are at. So we would rather try to look at other aspects like, are you an introvert or an extrovert? Do you have caretaking responsibilities? Whether it's about sick parents or you have small children, you might have to spend a similar amount of time taking care of someone in your household. It's also about commuting. Many young people might want to move out to the countryside. Many people who are older might already be out. So how do we accommodate for different needs in an organization that is so vast? I mean, Nina, you mentioned you have 30 different nationalities. That's fantastic. If you want to talk nationalities, we have 100, so we can exchange some experiences there. So if we look at cultural differences, if we look at gender differences, if we look at seniority versus juniority, but also at more deep diving, like diverse aspects, it's also about neurodiversity. It's about how you behave. It's about the type of meetings you prefer, because you might not be an extrovert. You might want to take a seat back and just wait until it's your turn to speak, but you want to be allocated a slot to speak because you don't take that yourself. So Delivery Hero as a company, I think our average age at the moment in our Berlin headquarters is around 32. So our issue might not be that we approach people age-wise in a different ways, but our problem might rather be, how do we attract a more senior talent pool to come and work with us so we can gain that level of experience in combination with maybe the firepower that a younger generation brings. We're rather looking at not exactly at the differences. Yes, they are important, but what brings us together. And everything that brings us together could ultimately also bring us apart because everyone is different. Even if I look at someone in my team who is the exact same age as I am, who has the exact same private setup, we differ. They might be comfortable with another type of giving feedback. Okay, then our feedback system needs to pay way for people who are different and who crave different things. So what I'm getting at here is, how do we gauge our workforce and understand what they want? And part of that is data. We don't believe in being data-driven because I think that brings away the human element of diversity and inclusion, but rather about being data-informed. So last year, we made our first ever diversity and inclusion survey. And we had a lot of fantastic insights coming from that survey, including the fact that many people want an older generation to join Delivery Hero because they think it's lacking. So it's not about closing the door, it's about finding what doors should we open and listen to our employees. And I might have exhausted my time on that question, but I think again, understanding what employees want, understanding what problems you have, it has to be a combination of heart and mind. And for us, the heart is the humane aspect and the mind is really bringing in the data.
Yeah, no, thank you. I agree. I think that's the beauty of diversity and inclusion. It's the beauty and the challenge. I mean, we have such a diverse pool of people. Everyone is different, but that also, of course, brings its challenges. And I think the great companies of the future will be able to tap into that and leverage the differences. And so maybe Till, on that, do you, when you shape your diversity program at Vantic, I know you guys are still smaller, do you look to any companies that inspire you in terms of diversity efforts? And do you think that it's possible to not copy, but look at other companies and what they're doing and kind of implement that within Vantic? Or do you think you have to start from scratch and really find what fits your organization?
I would say we definitely not do have to start from scratch, because there's good stuff out there. And you can learn, and you can copy, and you can even cooperate with companies. So to say, because why Delivery Hero has something, we cannot do that together. And for example, there's a lot of opportunities, and that makes sense. And we had one investor when the Black Lives Matter came up. We had one investor who really pushed the training on that, and I really loved that. That was super helpful, because we as a company, we couldn't have afford that. It would have been a big effort to organize such a training, and I was super thankful that they just came up and said, we do it for you because we can do that for 20 companies, and that was quite helpful. On the other hand, there's not one single example, because as was said already, it's not this, there's not one solution. And I think in the past, there's a lot of this kind of, Sunday speeches, or kind of in terms of LGBT, you say pink washing or whatever, which I don't want to copy at all. And so I've been growing up in an American organization where there was a lot of these a bit weird trainings, to be super honest, to have these behavioral stuff where you think, honestly, if you grow up properly, and that your parents should have done that. On the other hand, there was also a lot of good trainings and good stuff where I thought like, fuck, I haven't thought about that. And I really thought, okay, I really caught myself. So there's stuff to copy, stuff to learn from different organizations, and it's good to pick the stuff that fits best our organization. And the last point is, there's many stuff where there is no question or no answer to that yet, because we've spoken about COVID before. Honestly, talking about parents wasn't that much a topic, whatever, 12 months ago. I've done a lot of projects in the Nordics where this topic is treated completely different. They have a fantastic behavior, and there was no question about parents that had sick children at home or so, completely different in Germany. And I think, particularly in German companies, they have learned a lot that this is also, they have special problems. And so there's new stuff coming up, and the same about Kirsten, what you spoke or mentioned, the mental health, particularly about the younger people. These are the one from kind of caretaking I worried at least about before, because they were happy, they had power, whatever. And they were the one who were most frustrated. So suddenly you had to take care about a group of people that was not a problematic one. So it is also, you need to develop, and it will develop over time. And it's something you need to grow into that. So to make a long story short, it's something, okay, you can learn from others, and you should learn from others, but you need to tailor to your organization. And there is so many new questions where there is room for new invention and new good ideas. And for us, it will be probably a combination.
Yeah, I absolutely agree. I think this is an aspect of business where connecting with people and sharing ideas is definitely beneficial. No one is trying to steal how to be best diverse or best inclusive. So I think everyone can learn from each other in this aspect. So we're actually coming up on the time. Just to conclude, I would love to hear from each one of you if you could briefly describe how diversity has positively impacted your organization, and maybe just a story or anything that you want to share that has furthered your company through your efforts. And maybe Nina, you can kick us off there.
Yeah, maybe two and a half sentences. So within RatePay, I think existing diversity has led to enormous innovation. It's an incredible, innovative company, but also I find it particularly inspiring in the workforce. And it's a very open culture where feedback and constructive feedback is actively asked for and searched for. And I think you can only have this open feedback culture if you have a work culture that is based on trust and mutual trust across all different levers and aspects of the organization.
Great. Kirsten?
Basically, we've mentioned unconscious bias a few times. If you turn that round, it implies you're being conscious that different people have different opinions, no matter who they are. If you look at intersectionality, very clearly, all of us fit onto the different diversity sort of still buckets, I think I would call them. And I think once you start looking consciously at the person and listening to their opinion, you will eventually see that it's much more fun to work with each other. You deliver much better solutions. And at the end of the day, it's a very cool business case because you notice we're jointly much more successful.
Thanks. Nina, did you have something to add just now or? No, okay. Sigrid?
I think that two ladies before me expressed it really, really well. So I'm just going to say +1 on what was just mentioned, but adding an aspect to, again, perhaps the inclusion bit rather. Delivery Hero, if you look on paper, is already very diverse. Nationality, gender, etc., disabilities, you name it, we got it. But the other end is about inclusion. And for us, the epitome of inclusion is if we can foster a sense of belonging in the company, where you feel like you're not only invited to the party, but you participate in the dance, the pizza tastes really nice, and someone actually invites you to the dance floor. Like, that's being part of a company where you feel you want to go to every day, and where you feel like you can be yourself 100%. And when that is celebrated, cherished, and really put forward as a USP in the company. So if we can cater to that feeling and make sure that everyone has that going to work, what will we achieve? Better results, absolutely. Higher impact, most definitely. But what we will also achieve is that people want to stay. And if people stay, we can grow talents for the long run. We can keep them. They will ask their friends to come join us. And overall, we will just build a more robust organization. So when people say diversity and inclusion is something that, you know, it's nice greenwashing or pinkwashing, whatever you want to call it, like Till you mentioned, we say, no. It's about creating a company that's sustainable. It's about creating a company culture that's made to last. And that boils down to belonging.
Great, thank you for those powerful words. Till, you want to end us off?
Sure. Yeah, let's put, I agree to all what was said already. Let me add a business aspect. So for us, we want to disrupt a certain area of business. And to do that, we need to think out of the box. And I always see myself when I start to think, oh, I'm super creative, then I recognize, no, it's not. I'm so much, particularly in banking, I think in terms of regulatory, that's not possible. These are the restrictions here and there. And I stop my thinking at a point, and I see people who are from outside the banking industry, they come from a completely different angle. They start thinking where I stop thinking, and they question my barriers, my box I have. So for us, diversity, different viewpoints is crucial to succeed. And so that's why we desperately need it and need different points. And for us to keep that and not to get people into this regulatory barriers, that's not possible. And so this is super important so that they continue question everything because that is the driver behind innovation.
And there we're back to the beauty of diversity, that, you know, no one fits one box and everyone brings something else to the table. So it's definitely a powerful tool. Well, great. Thank you, everyone. This has been a wonderful discussion. I learned a lot on my half, and thank you so much. And yeah, now let's head back to the studio for more exciting Expo content. Thank you.
Thank you, Hannah.
Thank you, Hannah.
Thanks a lot.
Thank you.
Pleasure.
You see, looking into the human factor is as important, or maybe even more important, than looking into new technologies. So thank you once again for this inspiring panel to Hannah, and of course, thank you to all the panelists. We're slowly coming to an end of day one here at Fintech Europe Expo 2021. It's been inspiring, and I'd like to actually welcome back here on stage with me, Fernando Zornig. Hi, Fernando.
Hi, Felix.
Great to have you back.
Great to be back here on stage.
How did you experience day one of Fintech Europe Expo?
It's been an amazing day, full of excitement, a lot of great insights from the experts. It's been an amazing day.
And I hear we have some statistics that more than 1,000 people were watching us today from all around the world. How is that to hear that from you?
Yeah, I mean, that's the perk of virtual setting. It's great to have this kind of technology nowadays to support this kind of events, also to share the knowledge with the world. So it's great. It's a very exciting moment.
And I'm actually really looking forward to day two tomorrow, and we might even be able to raise the bar again. So if you have friends, colleagues, partners that might be interested in our content and into our conference, make sure you sign them up for tomorrow, and we'll have them here in day two and have them watching tomorrow. Moving on, Fernando, I think you have some big announcements to make, right?
Yes, that's correct.
All right, take it away.
Thank you, Felix. So we have some very exciting announcements to make. The first one being that we're extending our relationship with our partner Deutsche Bank. They brought us here back in 2018, and now we're extending that relationship to bring even more innovations inside and also to their customers and clients. Big shout out to Benjamin Bauer, Philip Martin, and Jean-Philippe for bringing that relationship also to every business unit within Deutsche Bank. The second announcement I would like to mention is the also extension of our relationship with Nets Group. Nets been a partner of Plug and Play for over 4 years now, and it's with a lot of excitement that we're going to continue this journey in 2021 and forward. The third announcement is that Cartão Elo, one of the biggest payment networks in the world, are extending the relationship together with us in Brazil and also here in Frankfurt and in Europe. They're bringing the technology from here to back home to Brazil and vice versa. It's been an amazing time, and let's see what 2021 holds for this relationship. The fourth and last announcement that I have to make, it's a really exciting one. 2020 has been a very productive year for Plug and Play. We have opened more than 6 offices worldwide, being the one in Switzerland, Turkey, Belgium, Chicago, South Africa, and Morocco. So bringing us to different continents that we weren't there before. And this is going to bring a lot of growth and excitement as well to our startup community and our partner network. So that's pretty much it.
That's it. I mean, those were some big announcements, Fernando. So 2021 has a lot in the bag, and we're really excited to see where it brings us, right?
Yes, that's correct. We're ready to roll.
Ready to rumble.
Yes, exactly. Let's see what 2021 brings to us.
And let's see what day 2 of Fintech Europe Expo 2021 brings. We'll be back tomorrow, but before we say goodbye for today, make sure you participate in the online conversation. Make sure you use our hashtag. What's the hashtag?
PNP Fintech.
PNP Fintech on Twitter, and make sure you use Facebook chat or the YouTube chat on the right hand side to type in your comments. Let us know you're there. We know you're there, but it feels a bit more like an audience when you actually reply and send questions or clapping emojis or whatever. I'm looking forward to day 2. It's going to be really exciting. And like I said, spread the word. If you have colleagues, your grandma, if she's into fintech, we never know. You never know.
Exactly.
Let her know. She might be there with us tomorrow. Some closing words?
Yes, of course. If you're a financial institution, a payment scheme, wealth and asset management, or a regulator, and you think you're late for innovation, get in touch with us and we're ready to support you.
You're never too late to innovate. See you tomorrow.